GS people, a very happy to all of you. So guys, we're doing this chapter called as final accounts of a company. And at present, we are having a discussion on the format of the balance sheet, which is mentioned under Schedule 3 of Companies Act 2013. Chalo. Very quickly tell me, the equity and liability set of balance sheet is comprising of how many broad categories of items? Four. First one being?
Four categories.
Yes.
Shareholders fund.
Shareholders fund. Shareholders funds. This is the main heading. Equity and liabilities. Under shareholders funds, what do we have? Very good.
Reserves and surplus.
Share capital, reserves and surplus.
Money received share.
Money received against share warrant. That's all? Okay. Second item. Reserves and surplus. Share application money pending allotment. Okay. Third one.
Non-current liability.
Non-current liabilities. Under non-current liabilities, how many sub-classification? Are you sure?
Four.
First one being
Long-term.
long-term borrowings.
Deferred tax liability.
Deferred tax liability only? Net. Deferred tax liability net.
Other long-term borrowing.
Other long-term liabilities. Be very careful. Other long-term liabilities. Then long-term provision. Long-term provision. Wonderful. And the fourth classification is current
liability.
Current liability. We haven't discussed the current liability yet, so I'm not going forward. Okay. We had learned yesterday, that is in last class, the difference between current liability and the non-current liability. Non-current liability means what? Long-term liability. Means the liability that I have to pay after 12 months of the balance sheet date or after the operating cycle period, for which I have sufficient time to arrange for money. Whereas current liability means the money that the company has to pay within 12 months of the reporting period or within the operating cycle period, which means the company has to run very fast for arranging the money that is required to be paid as a current liability. Correct? So now we understood there are four different pointers. If any one of those points triggers, then that is a current liability. If none of the points triggers, then it is non-current liabilities. So what is the first condition to call something as a current liability? A current liability is a liability if it is expected to be paid in the normal operating cycle period. Expected to be settled means what? In that normal operating cycle period, anywhere in that period we have to settle. Means what? Exact due date of payment is not given. Anywhere in between we can settle the amount. So if any money is to be settled within the normal operating cycle period, then that is my current liability. Second, if any amount is due to be settled within 12 months of the reporting date, even that is current liability. I said you to correlate A and C point together. I gave you 4 steps. What is the first step? Ascertain the normal operating cycle period of the business and also know the standard operating cycle period of the business, which is 12 months. This you compare and take the highest one. That is the step 1. Step 1 is what? Calculating the standard operating cycle period or the normal operating cycle period, whichever is higher. Second step, whatever months you have calculated using step 1, whatever months you have calculated using step 1, what are you supposed to do? Yes. From the reporting date. From the reporting date, calculate that period. So I'll do it here. So let's say normal operating cycle period was 13 months and standard operating cycle period is 12 months. So step 1 is what? Take the higher of these both. So what is the higher value? 13 month is the higher value. Step 2, this month you have to apply from the reporting date. So this is the reporting date. We are in the financial year 25-26. So no, 24-25, right? We are in 24-25. Come to your reporting date, which is 31st March 25. From there, please apply this 13 month. If I apply 13 month here, when does it end? 30 April 2026. 13 months will end here. Means 12 month of the next year and 1 month of subsequent year after that. So 13 months. So your 30 April 26. 30 April 26 becomes your benchmark date. So second step is to ascertain your benchmark date, benchmark month. Third step is what? To calculate your date of payment. When the payment is actually going to happen. So if the payment is happening here, if the payment is happening here, then fourth step, the payment is on or before the benchmark date, then this liability will be classified here as current liability. If the payment is going to happen here, here, or anywhere here, which is after the benchmark date, then this liability are classified as non-current liability as on 31st March 25. Any problem in this? Everybody is comfortable? Online people, everybody is comfortable?
Yes, sir.
Okay. These were the 2 points which is to be done together. Point number B, we spoke about the liability held primarily for the purpose of being traded. So we discussed about the financial instrument or derivatives, which is used as a tool to earn the speculative income. So this also we discussed in depth in the last class. Do you want to repeat this point one more time, or is it manageable? I gave you the example of currency, correct? No? So I entered into contract today to buy the currency at future rate. How much? 90 rupees. So today we entered a contract that I'll buy this currency in the future at 90 rupees. So this becomes my buy rate. You will come to future. In future, the value of this has become how much? Let's say 70. The day which is coming after 3 months, that day's rate now becomes your selling rate. Buy rate has already been contracted earlier. So now difference between your selling rate and buying rate is how much? 20 rupees. So now on that contractual day, you'll buy the currency for 90 rupees and sell it for 70 rupees. So there is a loss of 20 rupees. Means you have done a betting where you thought this 90 rupee worth of dollar will become in future 100 or 110 or 120. But your betting backfired and you lost the bet and your opposite person has won the bet. Since you lost the bet, you have to pay this 20 rupees to whom? The opposite party. So this is now your current liability because you have to pay this money in a shorter span of time. I don't have 12 months to pay this money. We have to settle it immediately. So hence this becomes my current liability. Am I loud and clear? Then we discussed the last point. The company where it cannot defer the liabilities. Means what is the difference between point number C and D? In point number C, they will tell you a due date. They'll tell you a due date on which you are supposed to make the payment. You have to make the payment on that date. You cannot defer it. That is point number C. Point number D says that you have to make the payment anywhere in between this period. Deferment is allowed, but the deferment could not be more than 12 months of the balance sheet date, which means you can do the deferment from this period to this period, not beyond 12 months of the balance sheet date. 12 months of the reporting date. From there, the deferment cannot be done. Within that period of 12 months, that is from the reporting date, within 12 months, you can do the deferment. But beyond that, you cannot do the deferment. There is no right to defer. This is point number D, which says that if that is the scenario, then that liability becomes your current liability. Any problem? We saw example based on point number D also in the last class. Do you have any doubts in this? 4 important points differentiating between what is current liability and non-current liability. If none of these conditions satisfy, if you don't come under any of these conditions, then your liability will be called as non-current liability. All the other liability are classified as non-current liabilities. Any problem? Online people, any problem?
No problem, sir.
Then we discussed long-term borrowing. There are multiple types of long-term borrowing. The first category is bonds and debentures. First category is bonds and debentures. Borrowing means what? Raising the money from the... It's not only public or third party. It's basically borrowing the money from anybody. The company can borrow the money from general public. The company can borrow money from the directors. They can borrow the money from the relatives of the directors. It could be anybody. So basically, we are doing the borrowings. The borrowings can be in any form. Taking the money from the public, in return, we are giving something called as bond. The bond has got a different feature. Taking the money from public, we're issuing debenture. The debenture has got a different feature from bond. So if it is bond and debenture, you have to classify under 3A. Then term loan. Term loan means what? You take the loan from the banker. The banker will give the loan to your account. The banker will credit the loan to your account. irrespective of whether you use that money or not, from the day when he's crediting the money in your bank account, from that day onwards, the time bomb will take. Time bomb for what it will take? Interest. That is called as term loan. So term loan, you'll get it from bank or some third parties, other than bank also. Then C comes deferred payment liabilities. Deferred payment liabilities. What is deferred payment liabilities? Yes. So it is basically, I've just tweaked the wordings here to make it more better. I've just made a modification in the language to make it more understandable. Companies often acquire capital goods. Capital goods means what? Assets or goods or services through deferred payment arrangements. Companies often acquire, buy capital goods such as asset, goods and services through deferred payment arrangements, which means that instead of paying the full amount upfront, the company agrees to make the payment over the extended period of its time in installments. And the installments are typically beyond the 12 months or the operating cycle period, whichever is higher. For example, I've taken a machinery worth 50 lakh rupees. Now, this I cannot pay in 1 year. So I told, give me 5 years of time. Give me 5 years of time. So machine is come inside. So machine account debit. Machine account debit. It is my asset. Am I making the payment now? No. The first installment begins from the next year. The money that I'm going to pay with the next 12 months is my current liability. Correct? So if I get an asset, machine account debit to defer payment liability. How much? 50 lakh. 50 lakh. Now this I'm going to pay over a period of next 5 years. The first installment will pay from the next year onwards. Okay. So now what happens? Out of this, 10 lakh rupees, what I'm going to pay immediately in the next 1 year, this is my current liability. Whereas the remaining 40 lakh rupees, I have still time to pay. I'm going to pay this beyond the benchmark date, and this becomes my non-current liability. So when this is non-current liability, where will you classify this under non-current liability? Where will you classify under that? Long-term borrowing. Because this is a kind of loan that they have given. When somebody is telling you, you take the goods now, give aram se. It is a kind of loan that they have given. And hence, this is a part of your long-term borrowing. Long-term borrowing, when I say deferred payment liabilities, the first thing what it strikes in our mind is it is only related to the loan. If at all I'm taking any loan for this particular item, and if the deferment is done like that, then only it is deferred payment liabilities. That is not only true. That is there. But apart from that, even if you don't take the loan, if a person is giving you the loan for, if the person is allowing you to make the payment beyond 1 year, even that will be termed as deferred payment liabilities as a part of your long-term borrowing. Am I loud and clear? The company agrees to make the payment over extended period of time in installment, typically beyond 12 months or the operating cycle period. This is common when asset is capital intensive and the company prefers to spread the cost over the future period. Deferred payment liabilities are not due for immediate settlement. Means what? I'm not going to immediately settle them. I'm going to settle them beyond 1 year. Meaning they are spread over a period and are classified as deferred payment liabilities under long-term borrowing of the company's balance sheet. So suppose the company buys a capital good asset worth 10 lakh and the payment is spread over a period of 5 years. The company agrees to pay 2 lakh annually over 5 years. And this liability will be recorded as deferred payment liabilities. So what would be the entry at the time of purchase? Fixed asset or machinery account debit. To deferred payment liability 10 lakh and 10 lakh. The first year when you make the payment, you will reverse the liability and record it through bank account. So this will be classified under current liability because you're going to make this payment within 12 months. What about the remaining 8 lakh rupees? I'll pay after 12 months. So in the balance sheet, you have to classify under long-term borrowing deferred payment liabilities. So initially it goes into one ledger called as deferred payment liabilities. So ledger is only one. But when you prepare the financial statement, you prepare on a piece of paper. You prepare on Excel sheet to be more precise. In that case, what happens? You have to reclassify it accordingly. So you will take as on 31st March of the current year, if the entire 10 lakh is outstanding. The entire 10 lakh is outstanding. 8 lakh will go to your non-current liability and 2 lakh will go to your current liability. Am I loud and clear? Any problem in understanding this point? Journal is not even there in your syllabus. Just journal is given to make you understand what the concept is. Your perspective now is to understand the disclosure requirement. The company's accountant will take care of all the accounting part. When I'm coming to the financial statement now, preparation of the balance sheet is only the presentation that we are focusing on and the disclosure requirement. Entries they will not ask. But entries you should be knowing. That's the basic thing. Then coming to Next one is what? Deposits. The money that you take from the public or any other people. If it is coming from the intercorporate, means what is intercorporate? You'll understand in next few classes. And from public. So you have to disclose that information in the balance sheet separately under deposits. Now, if they are secured against something, you have to mention that this is secured against the land. This loan is secured against building. Like that, you have to disclose the security if it is there. If it is unsecured, then in bracket mention it is unsecured. Point is given here. Borrowing always shall be further subclassified as secured or unsecured. If it is secured, then what is the type of security that is being given? You should be separately mentioning it. If the loan is secured by the land, then this in the bracket you have to mention that this loan is being secured by land, by way of land. Example. Next is what? Point number E, loans and advances from the related party. Related party in itself is a huge definition. It's got a huge meaning to it. We will discuss when the appropriate time comes, not now. Under this, we have three segments: loan from directors, loan from relatives, and intercorporate loan. Now, there's one important point to be understood from the perspective of the question that we're going to solve. In the question, they'll give you loan from director. Long term, short term, nothing they'll mention. So you have to make assumption. So what is the assumption that we can do? Guys, I'm telling you in the entire chapter. At applicable places, we'll be making assumptions. Now, assumptions can be made anything. Always we'll try to make the best case assumptions. Okay. So here they're telling that unless mentioned otherwise, if there is no mentioning about what type of loan from director it is, long term or short term, whenever the loan is coming from director or whenever the loan is coming from the related parties, always we presume or consider that to be short term borrowing and not the long term borrowing. So in the question that we're going to solve, if they give you loan from director and the question is not mentioning whether it is non-current or current, you will always assume it as current because the loan that the director and the related parties gives for a short-term period. I am arranging some loan from bank. Banker did not give me money on time. So I need urgently money for 1 month, 2 month, 3 month. I go to the data and tell data, please help me for this 3 months. You go to your related parties and get the help for 3 months. Always, whenever you go to the related parties and directors, always you take the short-term loan. That is the prima facie understanding. From the directors and related parties, you never take the long-term borrowing because you want to exploit the third parties, not the internal parties. Are you able to follow? That's the truth. No? So same thing you have to apply in the examination. Then came the concept of long-term maturities of the finance lease obligation. So in the last class, we understood finance lease obligation. Do you want me to repeat this one more time? What is finance lease obligation? A finance lease is a type of lease where the substantial risk and the reward of the ownership of an asset is transferred from the lessor, the owner, to the lessee, the user of the asset. So I want to buy an asset. I want to buy the asset. I don't have the money. Right? So somebody is having the asset. I tell them, please give me that asset. I want to use it. I will pay in installment. Once the installment period is over, at the end, I'll get the ownership back in my name. So this amount that I'm paying is not just completed in next 1 year. This payment I'm doing for next 10 years, 5 years, 8 years. Means the payment that I'm going to do is beyond the operating cycle period. In that case, this money that you're paying is called as long-term maturities of the finance lease obligation. So a finance lease is a type of lease where the substantial risk and the reward of the ownership of an asset is transferred from the lessor, who's the owner of the asset prima facie, to the lessee, that is the user of the asset, even though the legal ownership may remain with the lessor during the lease term. So what happens? I want to buy an asset, let's say plant and machinery. I cannot buy that machine right now by paying the full payment. So I tell, look, boss, this is a machine which is worth, let's say, 1 crore rupees. I'll pay you 10 lakh rupees for next 10 years. First year 10 lakh, second year 10 lakh, third year 10 lakh. So there's a person called as lessor. I'll be talking about this in detail when I do, AS 19. So lessor is basically the person who's having the asset, whose name the asset has been registered, owner. He is giving me the asset on lease. So I'm called as lessee. I am the person who's using the asset. And I will be the person who will record the asset in my books of accounts. Let's say I'm the lessee, I'm the company. I don't have the money to buy the asset for 1 crore rupees. So there's one party who's got the money. So he has taken the asset in his name. The ownership is with him. But I use the asset. So who will record the asset? I will record the asset. And every time I have to make him the payment. So once I make the full payment of 1 crore rupees in next 10 years, at the end of its useful life, the machine, the ownership will come back to me. This is the concept of lease. This I'll be discussing in depth when I do AS 19 with all of you. Am I clear? Now, this 1 crore rupees, what you're paying, 10 lakh rupees out of that, out of this 1 crore, 10 lakh you'll pay within next 12 months of the balance sheet date. First installment. So this becomes my current liability. But remaining 90 lakh rupees you'll pay over a period of next 9 years. So this 90 lakh rupees you have to pay in the second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, and 10th year. So this is long-term finance lease obligation. So this money you have to pay not on short-term basis, but on long-term basis. This money is paid against what? It is against a finance lease. It is a finance lease. Finance lease means what? When I don't have the money to buy the entire asset, I take the help of some other party. So he has the asset in his name. He is the owner of the asset. So I take the control of the asset. I use it. I pay the money. At the end of the useful life, the ownership is transferred to my name. This is called as finance lease obligation. Am I loud and clear? Do you have any problem in this? No issues? Now, if you still have some doubts about this particular segment, don't be bothered. So when I do AS 19, we'll do Aramse because that is entire chapters on accounting for leases. So that time we'll take care of it. Don't panic. Point number G, other loans and advances. If there is any other loan which does not fit into above 6 category, we will record in the 7th and the residual category called as other loans and advances. Any problem? Under each and every breakup, I've given a note. In the respective note, I've given what are the important points that you have to take care while doing the questions. While doing the practical questions, what you are supposed to take care of, that I've given in form of note. So there is no need to forget anything. Even if you forget it, come back and refer these points, you'll remember. Now, the next point that comes is deferred tax liability, which I'll be discussing when I do take accounting standard 22. As of now, we'll skip it. The point number C is other long-term liabilities. Other long-term liabilities. So we have to understand that what is being classified under other long-term liabilities. So Schedule 3 is told that two things will come under other long-term liabilities. First one is trade payable. Means what? The money that we owe to the creditor and the bills payable. And this is called as other long-term liabilities. Other long-term liabilities are part of which classification? Non-current liability. What is non-current liability? The money that we have to pay beyond the benchmark date. The money that I have to pay beyond the benchmark date. So the question what comes in your mind is, sir, in which business will the creditor accept the payment beyond the benchmark date? Normally, creditor will give a credit period how much? 1 month, 2 month, 3 month. If I go and buy any goods on credit, that person will give me the credit period maximum 3 months. Max to max, if you see in the worst case scenario, it will be 6 months. 180 days credit period anybody will give, but nobody will give beyond 6 months. So you are telling that we are having a creditor where we have taken the goods today, but we are going to make him the payment beyond the benchmark date, means after 12 months. Who is that? There are certain cases where it happens where the creditor is okay to receive the payment after the 12 months of the balance sheet date. It is a very rare sight. It is a very, very rare sight, but yes, there are certain scenarios where the creditors will accept the payment beyond the benchmark date. Like example, I want to buy an aircraft engine. Why? Because I am a manufacturer or I am a person who is assembling the aircraft. So if you see, for the aircraft, the very costliest component is what? The aircraft engine. The engine is the costliest part. Now this I am consuming for the purpose of manufacturing of my correct aircraft. It's a product that has been used for manufacturing the product which I'm going to further sell it. So here I will make the payment to him not in 12 months because we say that, look boss, you give me the engine today. I'll give you a small down payment. But this engine will come to me. I have to get all the other parts. I have to assemble aircraft. Then I have to keep it in the godown. Then one day I will sell it. Then I'll get the money. So immediately if you ask me the money, where will I go for the money, boss? So please give me the credit period. Sometimes this credit period also could be beyond the benchmark date. Means what? If your operating cycle period is 13 months, you may request, please allow me to make the payment 1 month after the benchmark date. Because 13th month itself money will come, we don't know. If the debtor delays payment by 1 more month, in reality, what do we do? On the paper, we say operating cycle period 13 months. Means 13th month, the money will come to me a hand. This is what we discuss. That is what we believe. But sometimes on reality basis, we don't get the money on 13th month. If the money is not coming on 13th month, I will not be able to pay the money to creditor. If I cannot make the payment to creditor on 13th month, my relation with the creditor will spoil. So what do we request creditor? Look, boss, in 13 months, money will come to me. But give me 1 month more cushion. Give me 2 months more cushion. I'll pay you after the money is received. So in case if the debtor is delaying the payment beyond 1 month, I will still make you the payment after that. So in that case, this creditor becomes your other long-term liabilities. Let me put it this way. You have taken the aircraft engine here. You have to pay him 2 crore rupees, example. Okay. And you've got a credit period. Now, this is the reporting date, 31st March 25. 31st March 25 is the reporting date. So this 2 crore, what you should classify? Imagine your work operating cycle period is 12 months. For easier sake, I'm saying, let's say we take it as 12 months. Operating cycle period is 12 months. Normal operating cycle also, stand also, both 12 I'm taking. So in this, whichever is higher, still 12 only. So from this, if I calculate 12 months, this is my benchmark date. 31st March 26 is my benchmark date. So if you make the payment of this 2 crore on or before the benchmark date, then this becomes my current liability. But sometimes what happens on the benchmark date, if the debtor does not give you the money, what will you do? Because what is your operating cycle period? The time taken to, the money that you've put in the raw material, the time taken for it to come back in form of money is called as operating cycle period. The money that you have put in the raw material from that stage till the money comes back to you is called as operating cycle period. So basically, you put the money somewhere here. You're getting back the money here on 31st March from your debtor. My point is that what if on 31st March or before 31st of March, you don't get money from your debtor? If you don't get money from debtor, how will you make the payment to creditor had you committed the payment on 31/3/26? Or well, if you're committing, no sir, on 31st March, that is on the benchmark date, I'll make you the payment you're committing. On the benchmark date, if your debtor does not give the money, then what will you do? So what do you do on safer side? Take extra credit period of 2 months. So what is the actual date of payment? 2 months later than this, which is 31st of May 26. So this is your actual payment date. But what is your benchmark date? 31/3/26, your benchmark date. So now the payment is happening on or before the benchmark date or after the benchmark date? After the benchmark date. And the person to whom I'm making this payment, who is he? He's the person who supplied the engine raw material for my product. So this is my creditor. This is my creditor. So in exceptional scenarios, when we make the payment beyond the benchmark date, the creditor could also be a long-term creditor. In that case, I will classify him where? Under other long-term liabilities. Where under other long-term liabilities? Under trade payable. Am I loud and clear?
Yes, sir.
Normally, if you ask me, if the question is silent and the creditor is given, it is by default current liability. If you see 99% of the time in the business, creditor will give you credit not beyond 6 months of the balance sheet or 6 months of the transaction. That is highest 99% time. But I'm talking about an exceptional scenario. So this is the 1% chance where exceptionally you make the payment beyond the benchmark date. So in case if you come across any company with whom you're auditing and where that company is making the payment beyond the benchmark date, then where will you classify this trade payable as? Other long-term liability. But what will your accountant do? He will not know all this, no, because he's not studied all this. So according to him, this is a creditor, and all the creditor should go to where current liability. That is the assumption. So when you do audit and when you check the documents, when you come across this kind of transaction, what are you supposed to tell him? No, 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 don't put in current liability. Since you're paying this beyond the benchmark date, you have to reclassify it from current liability to non-current liability. So this is a very common mistake that the entities do, companies do, accountants do. So while doing the audit procedures, you have to be careful that if they have classified wrongly under any category, means you have to get it reclassified properly. Otherwise, you will not be compliant to Schedule 3. And we have done it. Not exactly this transaction. There are multiple cases where we've seen that the accountant or the CEO of that company by mistakenly does the wrong classification, and while auditing, we do the right classification. So this is something which has to be done practically. Am I loud and clear? Am I loud and clear?
Yes, sir.
No energy. Am I loud and clear?
Yes, sir.
Yes, sir.
Next
Yes,
is
sir.
other category. One second, ma'am. Okay, doubt you had? Somebody ask me. You said you have doubt or no doubt?
We said yes, sir.
Okay, done. Now other category. So others, they have not given examples. I have given examples. Premium for redemption of debenture. You studied this in CA Foundation. What is this? Yes, this is current year 24-25. You have issued the debenture. Let's say on 1/10/2024, you have issued the debentures. Issued the debenture. What is the face value of the debenture that you issued? 100. But you said that when I'll redeem it, I will redeem at redemption value is 110 rupees. Means you're enjoying 100 rupees today, but in future when you're going to pay, how much are you going to pay him? 110 rupees. How much excess are you paying? 10. When are you going to redeem this? Let's say after 5 years. Let's say after 5 years. So now the life of the debenture is how much? 5 years. Life of the debenture is 5 years. Let's say it is not 110. For more comfortability, let's say this loan is taken. So debenture is issued on 1/4/2024. On 1/4/2024, you have issued the debenture whose face value is how much? 100 rupees. And you have promised to redeem after 5 years, at the end of the 5 years, and the redemption value per debenture is how much? 110 rupees. And what is the life of the debenture? 5 years. So please tell me, what is your redemption date? What is your redemption date? 24, 25, 25, 26, 26, 27, 27, 28, 28, 29. So 31st March 29 is the actual date when you will repay the money back. But we follow one concept, and we are supposed to record this loss immediately in the current year. What principle is that? Prudence concept, or it is also called as conservatism principle. It says what? Provide for the anticipated losses. So in 24-25, when you are accounting for the issue of debenture, that time itself you record the loss on issue of debenture, which is the premium on redemption of debenture. So please tell me, what is the journal entry when the debenture is being issued? Imagine the debenture that I've issued is 1000 numbers of debentures. So please tell me, what is the journal entry for issue of debenture? Very good. Let's say this is lump sum. No installment, this is lump sum amount. So bank account debit to debenture application and allotment. How much? So 1000 quantity of debenture into 100 rupees is the face value that we are collecting. So how much rupees? 1 lakh rupees we are collecting. And what is my next entry? Debenture application and allotment account debit to 9% debenture, let's suppose. To 9% debenture, 1 lakh and 1 lakh. Typically, with this, your entry is over. But what happens? There's a prudence concept coming into picture, which says what? You know that today itself, that in future you're going to pay this 10 rupee. So this 10 rupee, what are you supposed to do? You're supposed to apportion it over a period of 5 years. In 12th standard, what did we do? We recorded the entire 10 rupees in one shot in the year of 24-25. But when we came to CA Foundation, what did we learn? This is wrong. We have to apportion it over a period of 5 years. So this 10 rupee is a loss which is to be apportioned over a period of 1, 2, 3, 4, 5 years. Correct? But this loss has to be booked when? In the year 24-25 itself. Correct? So now please tell me, what is the next entry? Loss on issue of debenture account debit 10. 2. Premium on redemption, how much? 10 rupees. Out of this 10 rupees loss, how much will you book the loss in the current year? 2 rupees. This is 10 into how much? 1000. No? So how much does it become? 1000 into 10 is how much? 10,000. So 10,000 rupees is the loss. This 10,000 loss will you record in the entire 1 year? No. You will record it over a period of 5 years. Every year 2000, 2000, 2000, 2000 loss you will record in the P&L. Where in the P&L? In P&L where? Finance cost. It goes into your finance cost. Am I loud and clear? Now, this is a nominal account. This is a nominal account. Whereas, 2 premium or redemption of debenture is what? It's a liability. So now this 10,000 liability, where will you classify? This 10,000 liability, when are you going to pay? I'm going to pay beyond the benchmark date. This is the date of payment. Do you agree with me? This is date of payment. This is reporting date. So in the absence of normal operating cycle period, you're operating and normal operating. That is standard and normal becomes same. 12 months. So from here, if I calculate 12 months, can I say this is my benchmark date? Since the payment is going to happen beyond the benchmark date, then this 10,000 will be classified as non-current liability. But where is the non-current liability? I cannot take it to long-term borrowing. I cannot take the long-term borrowing. This will go to long-term borrowing. 9% debenture will go to long-term borrowing. But the premium that you're going to redeem in future, the extra money that you're going to pay in future is not your borrowing. It is a loss. It is your other liability. So it goes to your other long-term liabilities. Other long-term liabilities. Any problem? People, those who have not done your foundation properly, people, those who have not done foundation and coming to direct entry, it becomes very difficult for any teacher at the intermediate level to do a complete revision of debenture. Issue of debenture, redemption of debenture was extensively discussed in two places. One in 12th standard classes, CBSE, second in CA Foundation. So my humble request to anybody who's not done those chapters properly, please revise those topics and then come back and see this video so that you can understand what we are discussing. Whatever I've discussed is not a CA intermediate topic. These entries, what is visible on screen, is not a CA intermediate topic. It is a CA foundation topic. Now, do you understand the importance and significance of CA foundation? That to doing it properly, because every point has got connectivity in the intermediate level, and whatever you're learning in intermediate level, it has got connectivity to your articleship and your CA final level. So, can you forget any points? Impossible.
Sir, this nominal account will write to the extent of 2000, sir.
Correct.
The remaining loss on issue of debenture, what will you say?
Now, loss on issue. Now, the question what Kritin is asking is that, sir, this 10,000 rupees is there, no? In that 2,000 rupees, I'll transfer to P&L account. So remaining 8,000 is there in the loss on issue of debenture account. So what will happen to this 8,000 rupees? Now the treatment what you studied in foundation is very different from what you're going to study in the CA intermediate. So this will be covered in the upcoming sessions. That time you'll understand what needs to be done for this. There's one particular place where a similar type of question is going to come. In that question, I'll discuss what you're going to do with this problem. Next is what? Premium for redemption of preference share. Same concept. Security deposit taken. Security deposit taken. Sorry? No. This 2 premium for redemption of debenture is a liability. So this will go to your other long-term liability. Here, this 10,000 rupees is what? It's a loss. In that, how much loss you booked in the current year? Because matching principle says what? Record the losses to the extent of benefit received. By issuing this debenture for 5 years, benefit is coming for 5 years. Then how can you record the loss in the first year itself? So based on matching principle, you are apportioning it over a period of 5 years. And you're recording this 10,000 rupees as loss today based on the prudence concept. Because actual payment is happening when? In the future date. But prudence concept says what? Record all your anticipated losses now itself. Whatever loss you're anticipating in future, for which you have a clarity, that amount you recorded today itself. So prudence concept is asking you to record the future loss now. Matching principle is saying that this loss is to be apportioned over a period of 5 years because the benefit is coming for 5 years. So now here you have recorded 8,000 rupees in the, 10,000 rupees in the loss account. If I transfer this entire 10,000 rupees in the P&L account, then your matching principle is violated. So 2,000 rupees is transferred to loss on issue of debenture account. Then what happened to remaining 8,000 rupees is the question. So for that, there's a differential treatment which we'll be discussing in the upcoming session when I do the practical questions. Am I loud and clear? Now, security deposit taken. Imagine, have you all seen a scenario where if you're taking any EB connection, let's suppose if you're constructing a new house, you have to take an EB connection. Correct? When you take EB connection, they will charge you some security deposit. They tell you have to give a deposit amount. This deposit amount you have to pay to EB department. EB department will keep this deposit with them. And when will they give it back to you? When you surrender the connection back. So whenever in future, after 10 year, 20 year, 40 year, 50 year, 100 year, whenever you surrender the connection back, that time they'll give you the security deposit back. One example. Second example. Not now, it was prevalent in the days when we were studying in school, let's say 15, 20 years ago. Now we have a system called as mobile phones. Earlier we used to have a system called landline. We used to have a system called as landline. So which landline we used to have? BSNL. Have you heard of this? BSNL. So if I'm taking a BSNL landline connection, the phone will be provided by the BSNL company. For that, they charge a security deposit. That is for the phone, and for providing the connection, they'll charge a security deposit. Who has to pay the deposit? The consumer. The customer has to pay deposit to whom? The BSNL company, who's the telephone operator. This deposit the company takes, no? When will it give it back? Whenever you are surrendering the connection. So if I'm surrendering the BSNL connection, if I'm giving the telephone back to them, that time they will give my deposit back. Now, we are not talking from, the company, we're not talking about the customer now. We're talking about the company, BSNL or electricity department. When they receive the security deposit, can they enjoy that money forever? If yes, then that becomes their income. When they don't have to refund the money back, if I am, let's say BSNL, if I'm taking that money from your security deposit and I'm not going to repay you back, then that becomes my income. But when you now take the security deposit, there's a condition that you have to repay back whenever the connection is surrendered, which means this is a liability for me. But when am I going to repay this money back? In future, when this person surrenders the connection, he can surrender the connection after 2 years, maybe after 10 years, maybe after 20 years. We don't know. So generally, these kind of security deposits are long-term in nature. So Rudra, what happens? Where will I classify this money what I've received? So bank account debit to security deposit received. Bank account debit to security deposit received. This money I've received it. How much? 10,000 rupees. Is this my income? No. Credit all income and gain. Is this my income? No. This is my liability. To increase liability, credit. What type of liability is? Is it current or non-current? Is it long term or short term? It is long term because I don't have the intention to pay this back in next 12 months of the balance sheet date. So it becomes long term liability or non-current liability. In that case, where should I classify this? Under other long term liabilities. This is the meaning of security deposit taken. This is from whose point of view? BSNL point of view or customer point of view? BSNL point of view. From customer's point of view, it is the security advance is given. So that will be asset for the customer. So when I discuss asset classification, that time I'll tell you where it comes under which classification. Now we're talking about the security deposit taken. So when we take a deposit, we're talking about that security deposit. Now listen to me very carefully. There is one deposit given here. There is one deposit that is given here. Are these deposits same or different? Are these deposits same or different? It is different. This deposit is a borrowing where I enjoy that money, and for enjoying that money, I'm paying interest. It's a pure borrowing. Whereas this security deposit is only for our safeguard. Why are we taking security deposit? Tomorrow, if that person damages the mobile phone or let's say that landline connection, he puts down that phone and breaks, then where will I go to recover the money? Therefore, we keep as advance money. Are you able to follow? So, you were talking about the deposit taken. One example I can give like this. Second example, let's say this is the balance sheet of KVA Limited. So KVA Limited has got one classroom. The last classroom is there. No, let's suppose I've given it on rent on full-time basis. Okay. Now that person is using that room. Possibility is that he might damage any component in that room. Tomorrow, if it damages, then where will I go and recover the money from him? So what do? I take advance from him. I take deposit from him. Correct? No? Like when you take the house on rent, you give advance to your owner. So from owner's point of view, is receiving the advance money. So for him, what it is? Deposit. No. Are you lending the money to him? No. He's taking this as a deposit. Why? Because tomorrow, if you damage the premises, if you do not repaint and give him, he will use the deposit money to do the needful. So are you able to understand the difference between both the deposit? The deposit which is given under long-term borrowing is basically the money that has been used by me as a borrowing for the betterment of a business, for the development of the business, and I pay interest against it. This deposit, I don't want it for my business. This deposit is taken for a specific purpose. I'm not going to use this deposit in my business particularly. So I'm not going to pay any interest on this. This deposit I'm taking as a safety margin. So if tomorrow that person does something wrong to my product or my premises, I will use that money against it. Am I loud and clear? This is the meaning of security deposit taken. Next is what? Refund to debtor upon sales return, which there is a customer to whom we have sold the goods on credit. So when the person is, liking the product, he'll keep it. If he does not like it, what will he do? Take your product. I don't want your product. He will return the product back to me. So when the customer is returning the product back to me, what is my obligation? To repay the money back to him. If I repay the money back immediately, or if I'm going to repay the money back in next 3-4 days, for example, when you buy something on Amazon, you don't like the product, you return the product to the Amazon delivery guy. The money comes to your bank account how much after? 3, 4, 5 days, or sometimes it takes 10 working days also, 6 working days also. You don't know. Correct? So you're going to pay that money within a short span of time. So that becomes the current liability for the Amazon. So let's suppose you return the parcel on 30 March. Which means technically the person is liable to make the payment on 30 March. But what happens? You give the product to the Amazon delivery guy. He will give it to the warehouse. From the warehouse, it will go back to the vendor. The vendor will inform the company that, yes, I've received the product back. Now you can process the refund. So this entire process will take 1 week of time. So technically, when is the money coming back to me? When is the Amazon team paying the money back? Probably, let's say 6th of April. But this is due for payment when? On 30 March itself, it is due for payment. It is due for payment because return happened when? The ownership of the goods came back to Amazon when? 30 March itself. The delivery boy took the control of the product when? On 30 March. So which means what? The ownership is taken back on 30 March. Therefore, Amazon is supposed to pay when? The money on 30 March. But till 31st March, they did not make the payment and the year end came. So now this liability will be classified as current liability. Imagine you delivered the product, everything is returned. Now the vendor is saying, I have not received the product. So there's some confusion in the system and Amazon is not able to process this payment at all now. And there's a legal case going on, which is very clear that for at least next 12 months, they're not going to repay the money back. If at all repayment happens, it will happen beyond the benchmark date. So in that case, the money that I have to pay on 31st March, which is not paid and which is not likely to be paid in the next 12 months, but it is going to be paid beyond the benchmark date. So then it becomes your non-current liability. So whenever there is a refund to be done to debtor upon sales return, but the refund is not happening immediately due to any issue, and you know that the payment is not going to happen in next 12 months, but it will happen beyond 12 months, then that will become your other long-term liabilities. So where will you classify under the other category? Any problem? Online people, any problem?
Sir, the refund is
No, sir.
court case, you told me, sir.
It's not because just of court case. It could be any reason I'm telling you. Just not necessarily the court case. Even if it is court case, don't think it's contingent liability. You have to make the payment, but there's some process issue, hence the matter is gone to court. So you have to make the refund of the payment. That is sure. Even Amazon knows they have to repay the money. But there's some process issue because of it, the delay is happening. I'm just taking a random example. It could be any reason, not just a court case. It could be any reason. Maybe the debtor himself is agreed. Okay, give me the money after 12 months. So in short, what we have to know is that we will not go and dig the matter. What has happened? We will ask the account only one question. Are you going to make this payment to the debtor within 12 months or after 12 months? That's all. Reason could be anything. We are not going to reason multiple reasons. The reason is only to understand the situation. Situation can be anything. What as an accountant or an auditor we should know? Am I going to make this payment to debtor within the benchmark date or after the benchmark date? If it is after the benchmark date, it becomes my other long-term liability. That is the whole point. Am I loud and clear? Am I loud and clear?
Yes, sir.
Okay.
Yes, sir.
So the next point under the non-current liability is what? Long-term provision. In the CA Foundation, there's a particular session where I took and I made you understand what is the difference between liability, provision, and contingent liability. And I gave that recording, which is uploaded in YouTube, and I shared it in the group to all of you. How many of you watched it? How many of you not watched it? People, those who did CA Foundation with me, still I told you to watch it because I know you guys are Gajani. You will forget. And those who did not do CA Foundation with me, still I told you to watch it because in that I explained the meaning of provision in depth. What are the different types of provision? But the problem is in CA Intermediate, there's so many places I'll be touching upon on the CA Foundation. If I start explaining each and every point in depth here, we will not be able to complete the intermediate portions on time. So if you don't have things immediately in your mind here, then gone. So provisions is basically of two broad categories. Can you please tell me? Three it is, but we can summarize into two. Provision is of two broad categories. Can you please tell them or name them? Provision means what? Any money that I have to pay in future. Payment is confirmed, but amount not known. Example.
Provision for tax.
Very good. Provision for tax. Means in the current year end, I now have to pay tax to the government. But I cannot calculate the exact amount of tax because you will actually calculate the tax when at the time of filing your income tax returns. Maybe 1 week before filing income tax returns, you'll get to know your exact tax liability, which is typically in the month of July or September. But when you prepare the financial statement here, you have to create a provision on estimation basis based on the prudence concept. Correct? So what is this provision? This is a provision where I have to pay the money. This is an outflow of the money going to happen. But how much money? It is not exactly ascertainable. This is called as provision. This is called as provision. One example of this provision is called provision for tax. So one type of provision is where I have to make the payment in future, but the exact amount is not known to be. I calculate on the estimated basis. This is one type of provision. This I explained in more organic manner, in very organized manner in that CA foundation session, which I would want all of you to refer. Here I'm just trying to touch base it. I'm just trying to recap it. This is one type of provision. What is another type of provision? Another type of provision is the reduction of asset or reduction in the value of asset. One is another type of provision. This is another type of provision where it leads to reduction in the value of the asset. Reduction in the value of asset. Can you give the example of this?
Provision for depreciation.
Provision for depreciation and provision for doubtful debts. So what is the primary nature of the provision? It is a credit balance item. So when you create the provision, what is the entry for provision? P&L account debit. This is the entry that you have learned in CA foundation. Slightly I will change in inter. But since I have not taught it, I am going with the foundation concept. So what did we learn in foundation? P&L account debit to PDD. Provision for doubtful debt or provision for depreciation, whatever it is. If it is depreciation, then it is depreciation account debit to provision for depreciation. So this is provision for doubtful debts. This is provision for depreciation. In both the cases, you are crediting the ledger. So if any ledger it is credited and no other item is there on the debit side, then this ledger will have what balance? Credit balance. So all the provision will have what balance? Credit balance. So if I open the liability, provision for tax, provision for doubtful debts, provision for depreciation, all the three will appear on the liability side of balance sheet. Am I right or wrong? But out of these three, we will retain provision for tax in the liability side. Why? Because I'm going to pay this money in future. What is liability? Anything that I have to pay to someone in future is liability. Anything. I'm talking in a very layman language. In accounting language, technical way, I can complicate it, but I'm just trying to maintain a very layman language. What is a liability from a layman perspective? Any money that I have to pay to someone in future is liability. So provision for tax is the money that I have to pay to government in future. So if it is coming on liability side, I have no problem. But on the other hand, imagine no provision for doubtful debt, provision for depreciation. Am I going to pay this money to someone in future? The answer is no. So having these two items on the liability side, does it make sense? Not at all. So what do? We have the habit of regrouping it. So what do? We take these two from liability side to asset side. I told you this is left hand side and this is right hand side and the center line is like equal to. In mathematics, if any item goes from left hand side to right hand side, plus becomes minus, minus becomes plus. So this provision for doubtful debt and provision for depreciation on the liability side is having a positive balance. So when it goes on the asset side, it becomes negative. So what do? From debtor value, I minus provision for doubtful debts. Do you agree with me? From the fixed asset value, I minus provision for depreciation. This logic from 11th stand, I'm keeping on repeating it. 11th I repeated, 12th I repeated, foundation I repeated, again inter, 4th time I'm repeating this point here. Now, all these three are provisions. So when I'm talking about long-term provisions here, which provisions I'm talking about? Am I talking about those provisions that I'm going to pay in future? Or am I talking about those provisions which are going to reduce the value of the assets? Here we have long-term provision, no? Here the provision means which type of provision? The payment provision or asset reduction provision? Payment provision. So unless and until you're clear with this concept, you'll not be able to categorize the provisions correctly. So here we're focusing on those provisions that I'm going to pay in future to someone. Those provisions which I'm not going to pay, instead it is acting as a reduction of the asset that will be subtracted from the respective assets. So that provision I'm not talking here. I'm talking about only those provisions which I'm going to pay in future. Am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Regarding
Yes, sir.
provisions, again I'm telling you, please, the video what I've given to all of you, please watch it. In that video, I think it is for nearly about 1.5 hours or 2 hours video, where I've discussed extensively about contingent liability, provisions, and liabilities. What is the meaning of liability? What is the triggering point of liability? What is the triggering point of provision? What is contingent liability? I've given a full case scenario. So again, repeating that only will waste time for us. So my humble request is to please watch that video. I've put it in the group already. Now, there are two types of provisions category created by the Schedule 3. First is employee benefit provision. Means the provision related to employee benefit. Means there's some provision that is created for the purpose of employee. Which I have to pay this money to employee in future. One is provision for gratuity, one is provision for leave encashment. Now understand what is this gratuity. So gratuity is concept where if a person is working in a company for a longer period, for example, let's say beyond 5 years. So as a token of loyalty, you're supposed to pay him something over and above the salary. Let's say Sangami is here. So she's here for last 1 year. Now let's say she's in the business that is with me for let's say next 10 years. So now the moment she crosses 5 years, she now becomes eligible for gratuity. Now for this, you have to actually refer the gratuity act. Okay, how many years when it touches the employee becomes eligible for gratuity? Tax will teach you. In tax, you learn about in detail. I'm taking here for example purpose. Here for example purpose, I'm telling that if any employees are in my company for 5 years, the moment they cross 5 years, they're eligible for gratuity. Means what? They're eligible to get a reward over and above salary. And when will they get the payment of this gratuity? Not from sixth year onwards. They will get this money at the time of retirement. So if Sangama is retiring, let's say after 11 years, at the end of the 11th year, she'll get the gratuity. And she's eligible for gratuity since which year? 6th year. So Sangama is working here. This is 1 to 5 years she's been working, let's suppose. So after 5 years, that is typically from the 6th year beginning, she's eligible for gratuity. She's eligible for gratuity retrospectively. Retrospectively means what? From backdated. From backdated it will be given. From here she is eligible. And this will be paid when she is retiring. Let's say 11th year if she retires, that is when the gratuity is being paid. Are you able to understand? Now, in the first 5 years, am I supposed to create any provision for gratuity? Am I supposed to create the provision for gratuity? Yes. Because you believe that this employee will stay in your company for 5 years, considering that you will start calculating the provision right from year 1. So we have separate accounting standard governing this. So that time I'll discuss this in depth. Correct? We assume that, see, matching principle says what? Matching principle combined with prudence concept. Prudence concept says what? Record for anticipated losses. So we are anticipating that Sangami will stay with us beyond 5 years. And if she stays, we have to pay them gratuity. So 6th year, when I know that we have to pay gratuity, can I go back and record the expenditure here for 5 years? Is it possible? Please understand, if I'm giving gratuity of, let's say, 11 lakh rupees to Sangami, why? It is because of 11 years of hard work that she has done. When am I actually paying this money, 11 lakh? At the end of the 11th year. Matching principle says that if you record this entire 11 lakh as expenditure, when Sangami leaves on the 11th year, it will be violating matching principle. Matching principle says that you have taken benefit from Sangami for how many years? 11 years. Benefit is come from 11 years. Even this 11 lakh should be apportioned over a period of 11 years. Prudence concept says what? Record for anticipated losses now. So 6th year onwards, you'll start recording. But matching principle says what? It is more aggressive. It says you record it from here itself. Now the question that arises is that, how will I calculate this amount? How will I calculate this amount? So you will go to one expert called as actuaries. So this gentleman, he will use some mathematical data. Then complicated way, they have some own mathematical complicated way to calculate an estimated amount. They will give the estimation. So when I went to audit for multiple companies in Coimbatore and other places from Deloitte, we used to record this provision for gratuity. And the supporting document for this transaction is actuarial valuation report. That's all. So what I used to do, if I'm handling this particular segment, let's suppose I'm in charge of documenting for long-term provision. So here, whatever the amount long-term provision is there, I will see whether the evidence is there in the actual valuation report or not. If it is there, I'll give a cross-reference and leave it. I don't have to sit and brainstorm whether the actuary had properly evaluated or not. We will depend on somebody's professional skepticism. I will depend on somebody's professional knowledge. So here we believe that actuary is the right person to calculate this, and they have calculated it rightly. They have calculated it rightly. We believe that, and on that basis, we record the amount here. And now why this is long term? Because I'm going to repay this money only when the person is retiring. If I don't feel, or if I don't see the person retiring in next 1 year, if I don't see that I have to pay this money next 1 year, then why will I record this under short-term category? I will record this under long-term provision. So when you have no visibility when the employee is leaving the company, this provision what you've created will by default be recorded as long-term provision. So since year one, I'm recording this provision. Am I loud and clear? So when will I pay this money to Sangami? At the end of 11th year. At the end of 11th year. Now tell me if you have any problem.
So you have paid it for 4 years, sir. If she retires in the 4th year, that amount where you transfer.
Now the question is, sir, you created the provision in the year 1, 2, 3, 4. Okay. Sangami left before 5 years. Now she is not eligible for gratuity. So whatever provision you created, what it is supposed to do, you are supposed to reverse it. I'm telling you, there are accounting standards that we are going to discuss. In that accounting standard, we are going to discuss the accounting treatment for all of this. Guys, there's something called as accounting standard. How many accounting standard? 29 accounting standard. In that 2 deleted. How many we have? 27 accounting standard. What is the purpose of accounting standard? The accounting standard teaches us how to recognize those transactions in the books of accounts. How do you pass the entry? How do you disclose it? Okay. Now what are we discussing? We are discussing the disclosure requirement from schedule 3 point of view. Accounting point of view, there's a lot of things I meant to communicate. So if you ask me accounting related question, I can answer, but a lot of people will not be able to correlate to this particular point at this moment. So accounting part alone, I'm keeping it on hold. Wherever I feel that this concept you already studied, you know it, I'll discuss. But if I feel that this is too early for me to discuss now, that point I'll request you not to discuss now. Am I loud and clear? So now, long-term provision is basically, provision for gratuity is basically this gratuity amount that I'm going to pay to employee, then beyond the benchmark period. Hence, it will be classified as long-term provision. Any problem? Next is the provision for leave encashment. Leave encashment is a concept where if you're working in any company, let's suppose you're given 12 holidays. You can take 12 holidays. But if you feel that, no, I don't want to take the leave. Instead, if I don't take the leave, whatever 12 leave I've accumulated, pay me for that. One more time I'll discuss. Let's say I'm the company, all of you are the employee. I'm telling you 12 leaves you can take. Means what? You take the leave, I will not deduct your pay. It's paid leave. 12 leaves I give you and I will not deduct your salary. It's by default the leave I'll give you. Second, I'm telling you, I don't want you to take leave because if you take leave, what will happen? My work is getting affected. So I'm trying to throw one game here. If you don't take this 20 days holiday, you have a chance to encash that leave. Means what? If you don't take 12-day holiday, I'll pay you 1,000 rupees per leave. You didn't take holiday. So how much money you'll get? 12,000 rupees. Or I'm telling you, you don't take this leave, I'll give you 5,000 rupees per leave holiday that you don't take. So 12 once again. So 12 leave into 5,000 rupees per leave. If I encash and give it to you, you make 60,000 profit. So now I'm a hardworking person. I don't want to take any leave. So what will I think? Oh, if I work on other days, I'm getting so much salary package. Apart from that, if I don't take this 12 leaves, company is going to give me additional money called as leave encashment. Means the leave which I don't take, I can encash money against it. The company has given the leave. But if I don't take the leave, for that leave, I can encash money. So if I'm greedy of money, I will not take leave. I will think that let me accumulate all this. I will not take any leave. Rather, I'll encash. And the company will pay this money either after 12 months of the balance sheet date or beyond the 12 months of the balance sheet date. It depends on the company's HR policy. Some company says that I'll pay you this leave encashment at the end of the year. So we are in which financial year? 24-25. 31st March 25 itself, I'll encash the leave. I've paid the money, so there's no liability. Some company says that I will pay you within 6 months of the reporting date. In that case, that becomes my current liability. Some people say that this leave encashment, I'll not pay you now. I'll pay you when you retire. When will you retire? We don't know. So we assume that the retirement is going to happen after the benchmark date. In that case, this leave encashment is a part of your long-term provision. Long-term provision. Am I loud and clear? Now this leave encashment, if you can exactly calculate the liability, exactly known, then it is liability, not provision. So here what happens, you are not able to exactly calculate the value. Guys, what is provision? What is the difference between provision and liability? In the case of liability, you have to make the payment in future. In case of provision, also you have to make the payment in future. But in liability, you know exact amount what to pay. But in case of provision, you don't know exact amount what to pay. Here in this case, if you're not able to calculate the leave encashment appropriately, exactly if you're not able to calculate, you're calculating on the forecasting basis. In that case, this becomes your provision. If I'm able to calculate the leave encashment on yearly basis then and there, and if I'm paying within 6 months, then that is not provision. That is the actual liability I'll pay and I'll show it in current liability. It's a proper liability, not in a provision. If I'm able to calculate the exact leave encashment value, then that is not provision. It is my liability. Am I loud and clear? Yes.
So what is the difference between paid leave and leave?
So paid leave is basically you're telling that you take 12 days leave. For that, I'll not deduct payment. For that, I'll give you the salary, normal salary, cover. That is paid leave. If you don't take leave, that is that you can encash it. For example, I've given you 12 days holiday. No. If you take, let's say, 14-day holiday. If I take total 14-day holiday, in the 12 days is a paid holiday. Means what? For that, I'll not deduct any salary. But if you take extra 2-day holiday, no, that I'll deduct from your salary. So paid leave means what? This 12 holidays are paid leave. Means what? I'll pay you salary. You don't come, still I pay you salary. That is called paid leave. To take leave, I will not deduct anything from your salary. But if you don't take leave, I'll give you additional leave encashment. So leave encashment is a different concept. Leave encashment is the additional benefit that they're giving so that you don't take the leave. But if you take the leave, your salary will not be deducted. That is called as paid leave. So paid leave means what? Leave given to you. If you take leave, it is called as paid leave. The salary is not going to be deducted for that. If you don't take leave, and if there is an encashment option available, and if you encash that leave, that is called as leave encashment. Clear? Next is what? Other provisions. Means provision that is created other than employee, for the purpose of employees. Yes. Medical leave. Now, see, a company will have two type of leave policy. One is normal leave for 12 days, and there will be sick leave for 12 days. So sick leave is different, medical leave is different. Sick leave 12 days and your normal leave 12 days, total 24 holidays you can take. That is what my company gave me. When I was working in the previous company, they gave me 12 days of normal leave. This 12 days holiday, if I don't take, guys, leave encashment is only for normal days. And 12 days they gave me medical leave. Medical leave is not encashable. If you are sick, then they will adjust that leave from the sick days, not from the normal days. Let's suppose I'm sick for 6 days. So how many holidays I have total? HR concept we are going, man. 24 holidays we have. How much? 12 months of normal holiday and 12 months of sick leave. So 24 holidays we have. So when I'm sick, what did I say? Month. So you 12-month holiday means are your company gone? Sorry. 12 day of normal holiday, 12 day of sick holiday. So total how much? 24 days. So now let's suppose I'm sick for 6 days. It is sick leave. So they'll deduct from the sick leave category. So what is my balance sick leave? 6 days. And normal is 12. Now let's suppose I've never taken any holiday from here. I've never taken any holiday further. This will be lapsed. This is gone. This 12-day leave, if the company's got leave encashment policy, then I can encash it. If there's no leave encashment policy, nothing I can do. Nothing will be benefited. Yes.
So leaves taken for that year only.
Correct.
For the same year.
Amma.
How will it even come under non-correct?
I didn't get your point.
Sir, 24-25, sir. I'm taking leave on that year. Okay, if I'm not taking leave on that year, the company is gonna give me cash.
I got your point. Now, you have to wait for an accounting standard 15. Yes.
Maybe it's based on the period that they're gonna take to pay.
See, the problem of this chapter, what we're discussing is the restriction is only to the classification. Now, what you're asking is from the point of view of accounting. So, accounting will be discussed in the accounting standard. That's why I said, no, there's certain things we cannot discuss it. Because if I start discussing, then we'll be going outside that border. So there's a border line that I've drawn. In this border line, what are we going to discuss? Only schedule 3, formatting part. So what you're asking is very good question. I feel like answering. I'm very tempted. But what happens if I answer? It'll be like this. We're covering this broad aspect. If I go like this for each and every item, this will not be covered on time. Your question is very valid question. I have the answer for that, but this is not the right time to answer. This will be discussed when I do the accounting standard 15. Accounting aspect that time will be discussed in depth. Now clear? Now comes the provision for warranty. What is warranty? This mostly happens in the case of electronic businesses. The company says that when you buy a laptop here, let's say 1424, from this period to this period, the company will sell a lot of electronic items. Let's say they have sold electronic item worth 100 crore rupees. This company has seen in the past that people come to the company for claim. What claim? Claim for damages. If you remember, every electronic product comes with a warranty period. Warranty of 1 year. Normally it is 1 year. Means what? If this particular laptop is having some technical issues, if some part gets spoiled or some repair happens, the company will do the servicing free of cost. Let's suppose I got this laptop today. 6 months later, there's a particular part of this or component of this laptop which has got spoiled, and is a part of the manufacturing defect. You didn't spoil it on purpose. It automatically happened beyond your control. So we call it as manufacturing defect. So in that warranty period, if there is any manufacturing defect, if you take that laptop or any device to that particular company will replace that particular component free of cost. Free of cost is for you, but for company there is a charge, no? So now every year what happens? People come and claim the warranty. Now in current year 24-25, people will come and claim for the period where I've sold the goods in the previous or previous to previous year. Let's suppose I've sold the goods in previous year 23-24. So people, all those people who have purchased in last 6 months, they have warranty up till this period. Do you agree with me? So if any claim is coming here, I'll record the loss here. Correct? No? I'll record the loss here. Now this is violating which principle? One more time I'll tell you. This is 23-24. Okay. In 23-24, whatever goods I sold from 1/10/2023 to 31/3/24, last 6 months, what is the warranty period ending? Somewhere here. Those who have taken the goods on 1/10/23, the warranty is getting over on 1/10/24. 1 year warranty, no? So which means from this period to this period, the claim can come. Let's suppose there's a claim coming here. I have to pay 1,000 rupees. For customer, it is free because within warranty period, the product got damaged. He will happily take the free service and go. But as a company, I'm incurring the cost. No? Now, this cost is coming from that period where the benefit is received in 23-24. So, matching principle is saying that laptop you have sold here, benefit is coming in 2024, but you're booking the loss of this particular component in the year 24-25. This is not right. So, what they're telling, based on your past experience, you are supposed to create a provision in this year itself. That is in 23-24, when I'm recording the sale of the laptop, I have to create a corresponding provision on that particular laptop. You will ask that, sir, how will I create, sir? For that, you will take the past data. So past data means what? In the year 21-22, 22-23, you will see that what is the sale that has been done and what is the corresponding repair charges you have incurred. So you will take a ratio out of it. Let's suppose in this year I sold goods for 50 crore rupees. And on that 50 crore rupees worth of item that I sold, the damage what I incurred is, let's say, 1 crore rupees. Means the replacement cost what I incurred is 1 crore rupees, let's suppose. So what is the percentage? 1 crore upon 50 crore into 100. How much? 2% is my warranty claim. Means whatever turnover I'm doing, 2% of that is my warranty claim. So what is my provision that I'm supposed to create? 2% on the turnover. So now in 23-24, let's suppose my turnover is 100 crore. Every year, what is the average claim percentage? 2% is the average claim. So I will create the provision for current year. How much percentage? 2%. So 100 crore into 2% means how much? 2 crore rupees ka provision I will create. Telling what? I may have to pay this 2 crore rupees in future. Maybe next year or next to next year, I might have to pay. So based on the matching principle, we record the provision now itself. Am I clear? So some electronic product, the warranty is for 5 years. For example, if you take AC compressor, the compressor comes with a warranty of 10 years. So I create a provision for 2 crore here. The claim can come in next 10 years. And since this is a long-term claim, I will classify this warranty as a long-term provision of warranty. If the provision is created only for those products where the warranty is 1 year, then I'll classify that as short-term warranty provision. But there's some products where the warranty period is beyond 1 year, 2 year, 5 year, and 10 year. AC compressor warranty is 10 year. In that case, 7th year, if the customer comes and tells me, so this is the problem, Now I am covered under warranty. Please service freely and give me. Please change the component and give me free of cost. So for customer, it is free of cost, boss. But as a company, I have to incur the cost for it. No. So if I record the cost in the 7th year, the benefit is coming today. Matching principle is not matching. So what are we doing? If the benefit is coming in the current year, means what? If that particular AC is sold in current year, you have to estimate its warranty claim to some extent based on a history in the current year itself. We have to create the provision of loss. So provision for warranty is nothing but the loss that we are estimating and recording now. When will I incur this loss? Not today, in future. So we are recording that loss today itself. How, on what basis are we estimating? Based on the previous experience, based on the history of last 5 years, 10 years. I have my history, no? Okay, so much of turnover done, in that so much claim came. So either on simple average basis or weighted average basis, I'll create one percentage of warranty. That you will learn when you go practically, when you go see it, you will get to know. I have practically seen this case in Coimbatore. There's one company by name Herotech. They're into manufacturing robotics. What does this robotics do? These robotics are installed by the automobile companies. You know, in the automobile industry, when they manufacture a car, that is not manufacturing, that is called as assembly. So they'll have big assembly line. So in the assembly line, they'll put the car. First, they'll put the chassis of the car, means what, the skeleton of the car. Then it'll go to the next level. The robot will fix the metal body. The next robot will fix the door. The next robot will fix the wheel. The next robot will fit the different parts. So the robot was doing all fitment. That robot was manufactured by this company called as Herotech. So now obviously that machine is coming with a warranty of 5 years. Soma is coming with warranty of 5 years. Now we created a provision on this particular robots what we sold in the current year. No, if I sold any robot in the current year, we created a provision on that of in current year, and the claim could come in any of the next 5 years or 10 years. So on what basis did I create the provision now? Keeping the past experience into consideration. So I took last 10 years data. We took last 5 years data. We saw what is the turnover there done. In that period, what is the provision that claim, the what is the warranty claim that came? So we took an average percentage of that. Weighted average is the best method. If you take the weighted average method, you get a provision percentage. On that basis, we created a provision in the current year to satisfy the matching principle. Is the logic clear? All this explanation not required to be given. To be very honest, you go anywhere, they'll just tell you if this is their long term, if this is their short term. But I don't feel like just discussing the classification going. I feel I should be discussing the item with you, because once you understand the item, meaning of it, you can understand in better way and you can apply your mind and classify it accordingly. So it is my nature that I have this intention of, okay, let's explain. Without explanation, I don't feel satisfied of teaching. That's why I'm going in so much of depth, otherwise not required. Provision related to assets. Example, provision for depreciation, provision for outward debt will not be shown either in the short-term provision or long-term provision. It will be reduced from the respective assets. So here we are talking about only those provisions which have to pay in future. That provision alone we are classifying under long-term or short-term. So if any provision that we are creating now, where we have the intention to pay this money beyond the benchmark date, it is long-term. But if you believe that I'm creating a provision and I have to make that provision ka payment within next 12 months of balance sheet date, then that provision becomes your short-term provision. Am I loud and clear? So if I come to current liability, we have something called as short-term provision. Provision for tax is one example under that. Provision for tax means what? Whatever provision you're creating at the end of the current year, you have to pay them within the 6 months of the balance sheet date. Companies has to submit your income tax return by 30th of September. April, May, June, July, August, September. 6th month is the last date of submitting your income tax return. So which means always your provision for income tax is short-term, short-term, short-term. Because you have to settle this within 6 months of the balance sheet date. The due date for filing income tax return is 6 months of the balance sheet date. So in that case, always provision for tax is going to be short-term. Provision for tax will never be long-term. And if any advance tax you've paid, that you have to minus it. What is this? I'll discuss when I do a practical question based on this. If there is any provision for gratuity or leave encashment that you're going to pay next 1 year, if there is any provision that you're going to pay next 1 year, you know that, okay, this is the money that I'm going to pay. Suviksha, your case example came here. If I'm going to pay this leave encashment in next 1 year, within next 1 year, if I have a visibility of that, then this will be calculated under short-term provision. Short-term provision. Now your question is still pending. Sir, why this is provision and not a liability? Because I can still calculate the exact amount. So this you have to wait for. Yes. So if any provision created which is due for payment within 12 months of balance sheet date, it is short-term provision. Any provision created which is due for payment beyond the benchmark date, it is my long-term provision. Any problem in this? Online people, any problem in this?
No, sir.
No, sir.
With this, we are done with the long-term liabilities, which is non-current liabilities. Can we go to current liabilities? Under current liabilities, we have the first item called short-term borrowing. Whatever items we discussed in long-term borrowing, same thing is short-term. Means what? Any money that is due for payment within 12 months of the balance sheet date, reporting date, or within operating cycle period, which is higher, that becomes your short-term borrowing. But in this, there's one important point to be discussed. Current maturities of long-term debt. This is one place where the ICA will definitely check upon. And this was a favorite topic where also back then in 12th CBSE. And same point we're discussing now also. That apart, you take anything else. Loan repayable on demand. What is loan repayable on demand? You've taken loan from bank. Bank says that whenever I ask, you have to pay me. So you can ask anytime. Means I may have a pressure. Whenever they ask, I may have to pay the money. So this is my urgent liability or aram liability or relaxed liability. This is urgent liability. So this will be classified under short-term borrowing. Now, if it is secured against something, you have to mention the information about the security. So typically your bank overdraft. What is bank overdraft? What is the difference between term loan and the bank overdraft? Though I discussed this with all of you in the CA Foundation. In which topic? BRS. Bank reconciliation statement. I gave you the difference between bank overdraft versus term loan. What is it?
Whether we use it or not, we have to pay for the term loan. For the bank overdraft, whenever we use the amount, we have to pay.
Perfect. In case of term loan, what did I say? You go to the bank. Tell bank, I want the loan. Which loan? Term loan. Bank will check all the history. Bank will check whether you have the repayment capacity or not. Bank will check whether you have sufficient income or not. Everything they'll check. And finally, they'll say, okay, tatastu, I'll give you the loan. The day when the loan is sanctioned and credited to your bank account, interest will be calculated right from that day, whether you use that money or not. Which means today, let's suppose bank gave me loan of 10 crore rupees in my bank account on 1 March 25. Till 31st March 25. Entire 1 month, I have not used even 1 rupee of the 10 crore rupees. 1 rupee also I didn't use in that 10 crore. Am I supposed to pay interest? The answer is yes, because this is a term loan. Interest will start ticking the day when the money is credited to your bank account. So a lot of people did not want to go for term loan and the bank started losing their clients. So bank is into lending business. What is their primary source of income? Interest. So they thought, okay, what else I can do in such a way that people will still take my loan? So they came out with the concept of bank overdraft. They said that now come to us. Don't ask term loan. Ask bank overdraft. Means what? I'll give you a limit. Whenever you want to use that money, from that limit, you can automatically withdraw. For example, I went to a bank, opened a current account. All of you know what is a current account? In the current account, I have 10 lakh rupees, my money. How much I can withdraw? Only 10 lakh rupees, nothing beyond that. Do you agree with me? Now what happened? With this current account, I have filled an application of bank overdraft. I have to go to the bank, fill an application that make my account a bank overdraft account. Now they'll ask you limit. How much limit you want for loan? You will say, I want 20 lakh rupees. Let's suppose they gave you 20 lakh rupees the loan limit. Means what? In future, if you want to withdraw the money, I can withdraw my 10 lakh rupees. And plus, I can withdraw how much more? 20 lakh rupees more. So how much money you can totally withdraw now? 30 lakh rupees. Let's suppose I had made a payment in check for 12 lakh rupees. So 12 lakh rupees minus if I do, it is negative 2 lakh rupees. So out of this 12 lakh rupee payment that you made, 10 lakh money went from your account. That is your money it went. Extra 2 lakh payment, how were you able to make the payment? From the overdraft limit. What is the overdraft limit? 20 lakh was the overdraft limit. In that 2 lakh rupees you have utilized. So what is unutilized limit? 18 lakh rupees. Now when bank will charge interest for you, will they charge on this 20 lakh or will they charge on 2 lakh or will they charge on 18 lakh? They will charge on 2 lakh rupees. Means for the money that you have utilized, for that only they'll charge interest. And the beauty of this is what? If you have withdrawn this money 2 lakh, let's suppose today 1 March, and again you gave the money back to the banker after 4 days. Let's suppose your customer gave the money back to your bank account. When? On 4th of March. So bank lent this money for how many days? 1 March, 2 March, 3 March. Because 4th March money came back. So bank will charge interest only for 3 days. So if any money is coming back to your bank account, whether you put it or your customer puts it, anybody puts it, the banker will take the money first against their loan and they'll adjust it, and that will stop your interest. That way, banker attracted a lot of business people. The same point I discussed elaborately in the CA Foundation. I have a time constraint, so I cannot discuss this too much in detail. I'm just trying to recap the points here. Correct? No? The same point we took almost half an hour to discuss this entire scenario. Can I discuss the same half an hour here for each and every point? Then in this Janmam, we cannot complete CA intern. Now this is called as bank overdraft. Another name for bank overdraft is what? Cash credit. Cash credit. Cash credit has got one additional purpose. You can withdraw the money. In cash credit, what happens? You can withdraw the money also. In bank overdraft, what happens? You can transfer the money. Extra money, you can transfer it. Transfer bank overdraft is possible. I want to withdraw money. I'm going somewhere outside. I don't have money. I want to withdraw money. In cash credit facility, you can withdraw the money also. Am I clear? So this is a thin line of difference between both. Slight difference is there, but very thin difference. These are always on demand payment. Means what? Bank gave you loan of 2 lakh rupees, correct? Today, when? 1 March. Bank took back the loan from you. When? My customer put money back. The moment money came to my bank account, banker took the money immediately. So these type of liabilities are what liabilities? Short-term liabilities, short-term borrowing. Correct? No? Arey Baba, what did I say? You have 10 lakh rupees in your bank account. Correct? You made a payment of how much? 12 lakh rupees. You made the payment debit. So your balance became negative 2 lakh rupees. Correct? Now, after 3 days, after 3-4 days, the customer paid you 6 lakh rupees. So plus 6 lakh rupees means how much it become now? Positive 4 lakh. So 6 lakh came. It is only 4. Where did it 2 go? Banker took that money. Means what type of liability this is? This 2 lakh is my liability. No, what liability is this? Short-term liability. Because this money banker will take anytime the money comes to my bank account. Hence, it is my short-term borrowing. It will be classified under the category loan repayable on demand. In this, if you have any doubt, please ask me. Correct. Next is what? Loans and advances from the related parties. So always it is short-term. Always it is short-term if the question is silent. Deposits, other loans and advances, A, B, C, and E is something manageable. The dangerous point is what? Point number D. Are you all ready for it? Or do you want a break? All of you want a break? Okay. Take a proper break of 10 minutes. Keep yourself very fresh and refreshing, because the next concept is slightly tricky. If you do not pay your full attention, you will not be screwed. You'll be royally screwed. Thank you. Yes, people. Welcome back from break. So let's continue. So guys, before the break, we are discussing this classification of short-term borrowing. In that, I told you there's one particular segment which might bother you, which is current maturities of long-term debt. So this I'll make you understand through a small example. Example number 10. It says that XYZ Limited issued debentures for 1 lakh when on 1st April 2020 to be redeemed at par as on 31st March 2025. So how many years are we going to use this money for? 2021, 21, 22, 22, 23, 23, 24, 24, 25. 5 years. The company, however, did not redeem the debenture on the agreed due date. Means on 31st March 25, the company did not make the payment. Means they defaulted the payment on the due date also. You are required to classify the borrowings. Whatever the borrowing we have done debenture, how will you classify this in the financial statement of all these 5 years? So we are now going to prepare the financial statement for the 5 years, starting from 31st March 21. Okay. Now, please tell me, if I'm preparing the financial statement on 31st March 21, this 1 lakh borrowing will be classified as long-term or short-term borrowing. Okay. Short-term. Surya, I'm very sure. Short-term. A question here it is, ma. This 1 lakh rupees borrowing, what you have done debenture on 1 April 2020, on 31st March 21, will you classify this as long-term or short-term? Long-term. Okay. Short-term. Long-term. Long-term. Short-term. Long-term. 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 short term, short term, short term, long term, long term, short term, short term. Wonderful. Those who said long term, you just wait and watch. Gone today. You'll be rewarded by me. You'll be rewarded by me. Those who said short term, nothing. Those who said long term, you'll be rewarded by me. Wait and watch. You'll be rewarded. Truly, I'm telling you. கொஞ்சம் லாங் டர்ம் கொஞ்சம் ஷார்ட் டர்ம் அதுல ஒண்ணும் சொல்லுமா ரீபேமெண்ட் அட் பார்னு சொல்லியிருக்கேன் நான் பிரீமியம் ஆமா ஹலோ ஷோ ஃபர்ஸ்ட் இயர் விச் ஃபினான்ஷியல் இயர் 2021 okay next year 21 22 22 23 anybody from short term want to go to long term or long term to short term window is closed now 23 24 24 25 what is the date of repayment 31st March so date of payment is 31st March 25 can I say this is fixed it's due for payment deferment not possible due date also fixed okay now what is the reporting date here in the first year this is the reporting date 31/3/21 reporting date now this 1 lakh rupees when I classify this year long term or short term you said short term wait I'll come to short term first long term I said will be rewarded I'll give you chocolate because the answer is right what he said long term is right answer those who said short term aha oho what is the meaning of current liability 12 months or operating cycle period have they given here no in the absence of operating cycle period we assume it to be 12 months 12 months is the operating cycle period first step second apply the 12 months from the reporting date if I apply the 12 months from the reporting date this is my benchmark date am I making the payment on or before the benchmark date or after the benchmark date after the benchmark date so on 31/3/21 what liability this is non-current liability under non-current liability this 1 lakh where will I show long-term borrowing it is borrowing debentures are borrowing in category A bonds and debentures I will show under long-term borrowing those who said short-term borrowing I'll send you to LKG now not foundation not 12th 11th only I'll send you again one more time that is LKG for accounting no that's when you started learning accounts I'll send you there directly Katti Nathan. I took one entire class. What is current liability? What is non-current liability? What is benchmark date? What is on or before benchmark date? What is after benchmark date? Oh, you. One class I took just like that. And you're doing this is short term. Donkey fellows. So 2021, can I say it is long term? So 31st March 2021, it is non-current liability. Where is the non-current liability? Long-term borrowing. Okay. Next, I'm coming to the next year, 21/22. 21/22 is my reporting date. 31st March 21. So can I say this is going to be my benchmark date? Am I making the payment on or before the benchmark date or after the benchmark date? So this date of payment is after the benchmark date. Since it is my long-term borrowing. So for 31st March 22 also this is non-current liability, long-term borrowing. Okay, not okay. Now what is my next reporting date? Oh, Seri, Papa, finding fault always in sir. You understood my emotion now. 31/3/23 is my reporting date. When I prepare the balance sheet here, this 1 lakh is current or non-current? Simple. Again, ask the same question. From here, if I calculate the benchmark date is getting over here. This is my benchmark date. Am I making the payment before the benchmark date or after the benchmark date? After the benchmark date. So this 1 lakh also non-current liability. Where in non-current liability? Long-term borrowing. So 31st March 23 also this is non-current liability in that long-term borrowing. Any problem?
No, sir.
Online people so far any problem?
No, sir.
Now we are in which financial year? 23/24. Now this becomes your reporting date. 31st March 24 is reporting date. So when I prepare the balance sheet here, now this 1 lakh I'm yet to pay. Now this 1 lakh is current or non-current?
Correct.
Now again same thing. From here I'll calculate the 12 months period. So this becomes my benchmark date. I am supposed to make the payment on or before the benchmark date. So this becomes your current liability. Now the question is, under current liability, there are so many options. Which option will you take? Short-term borrowing. Oh my God. Under short-term borrowing, which category? Current maturities of long-term debt. Oh. Now there's one point you have to be very careful about, especially if you're referring any textbook, any question before the year 2021. You have to be very careful. Before 2021, this current maturities of long-term debt was a part of your other current liabilities. In the 2021, this current maturities of long-term debt was a part of your other current liabilities. In the year 2021, there's an amendment that was brought in by company law, which said that now they're regrouping this current maturities of long-term debt from other current liabilities to short-term borrowing. So from 2021 onwards, current maturities of long-term debt is a part of your short-term borrowings. Now are you clear with this point? Everybody.
Yes,
Online people, am I loud and clear?
Yes, sir.
Yes, sir.
Now, the game is not over here. The game is not over here. On 31st March 24, you have reclassified this. You have reclassified this from long-term borrowing to short-term borrowing because I'm going to pay within next 1 year. So it is short-term borrowing. Where the short-term borrowing? Current maturities of long-term debt. This you don't forget. Now, they are telling that on 31st March 25, this is date of payment. On the due date, you have defaulted the payment. The company, however, did not redeem the debenture on the agreed due date, which means on 31st March 25, the money was not yet paid, which means the money is yet to be paid, which means this is still a liability. Now the question is, this 1 lakh rupees is currently now where? In current liabilities under that short-term borrowing. So where will this 1 lakh be now? Same category or different category? Sir, current liability will be the same category because I have to pay this money anytime sooner. I may pay on 1st April 25. I may pay on 1st May 25. I may pay on 1st June 25. I can pay any time. I can pay any time because it's already due. It is already due, boss. I have to pay any time. The debenture holder can come and catch hold of my neck anytime. So I may have to pay it anytime. So it is current liability because I have to make urgent money ready. Payment has to be done on urgent basis, current liability. But now you have to reclassify this from short-term borrowing to other current liabilities because it is no longer a borrowing. Borrowing means what? When the debenture holder happily gave the money to you to enjoy the money, that is borrowing. Now here, the time for repayment has come. You have not repaid the money. Debenture holder is not happy about it. Now you're using the debenture holder's money. But is the holder giving this money happily? No. He has given you this money as a borrowing? No. The due date has come. The borrowing is over. So this money is no longer borrowing. Borrowing means what? Enjoying money happily. So this money or what you're enjoying after 31st March 25, Piyush, it is not happy money. It is somebody's curse. Somebody is wanting the money back. You're not giving the money back. So this person is cursing you. So this is cursed money. Hence, it is a part of your other current liability. You will not call this money as a short-term borrowing. This is not your borrowing anymore because it is due for payment. You have defaulted the payment. So it is not your borrowing. Borrowing means what? When somebody happily gives the money to you. You enjoy the money with somebody's permission. That is borrowing. Now here, debenture holder wants the money. You are not giving the money. So it is no longer short-term borrowing. You will reclassify from short-term borrowing to other current liabilities. Am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Yes, sir.
This will be now called as this money, which is not paid on the due date, will be called as unpaid matured debentures. Unpaid matured debenture. My question is, what is the meaning of matured debenture? The debenture which is matured for payment, but you have not paid it. It is called as unpaid matured debentures. Am I loud and clear? Online people.
Yes, sir.
So now, on the date of payment, if the money is not paid in that particular financial year, that will be classified under current liability. Where under current liability? Under other current liability. Where under other current liability is unpaid matured debentures and interest accrued thereon. Any problem? If this 1 lakh rupees is taken in form of deposit, then you will call this as unpaid matured deposit and interest accrued thereon. If it is any kind of loan, there is unpaid matured loan and interest accrued thereon. If there is any interest that is also not paid, that will be classified as unpaid matured principal amount plus interest amount put together you will classify. Am I loud and clear? So this will form part of your main question. Now the question that we are going to work out from Monday onwards, this type of question will be a part of your big questions. In this, if you have any doubts, please ask me. Very, 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 very important.
We'll reclassify this to other current liability on 31/3/25.
Yes. Always on the reporting date, you have to reclassify. Always on the reporting date, you have to reclassify. So guys, in the first 3 years, I classified that 1 lakh rupees as what? Long-term borrowing. 1 year before the payment, 1 year before the payment, I classified. Rather, I reclassified from long-term borrowing to short-term borrowing. Where in the short-term borrowing? Current maturities of long-term debt. Now, in the current year, if you have not made the payment, if it is still outstanding, due date has come, you have not paid it, still it is unpaid, then I'll reclassify this from short-term borrowing to other current liabilities. Where in other current liabilities? Unpaid matured debentures. Is the logic clear or not clear?
Yes,
Online people, is the logic clear or not clear?
Clear, sir.
So on
Clear,
31st
sir.
March 24, you have reclassified from non-current liability to current liability, from long-term borrowing to short-term borrowing. Where in the short-term borrowing? Current maturities of long-term debt. On the date of payment, you'll reclassify. That is, if in the last year, when you're reporting it, if it is still unpaid and the due date is gone by, then you reclassify from short-term borrowing to other current liabilities, and from current maturities to it will go to unpaid matured debentures. Is the logic clear or not clear?
sir, I have the
Yes.
fourth one, sir. The reporting date, this is the date of reclassification.
Correct.
It will be 1/4/24 only, so that time only we'll reclassify.
Kana, we are preparing the balance sheet on 31st March 24. No. I'm telling you, if 31st March 24, from here, you are due for payment in any time in next 12 months. So this becomes your current liability. No? Clear, no? Any problem in this? Please tell me. Online people, any problem? Online people, are you all there?
Yes, sir.
Okay, any problem in this?
No, sir.
Okay, offline people, any problem in this?
No, sir.
Short-term borrowing, are you all clear? Everything is clear. Now, trade payable. Now here, there is an amendment that has happened in Companies Act, which said that now the trade payable will not be disclosed just like an information. Means what? So much money you have to pay to creditor. Amount mattu kuduthu vidakudadu. They said that you have to give more information to trade payable. Listen to me very carefully. Listen. In 2021, a significant amendment came. In 2021, a significant amendment had come in companies law. In that, they said that information with regard to trade payable needs to be elaborately given. Means what? Just giving the information about how much money to pay, that is not sufficient. You have to tell me this money which is to be paid to creditor, for how long you have not paid the money. You have to give the information. Why? Because you know in 2020 what came? COVID. During COVID period, what happened is a lot of people did not have the proper business happening. So their inflow was money was not happening. The rotation of money was not happening. So what happened? A lot of companies withheld the payment to the creditors. Which creditors? We are talking about those people who are coming from the small background, medium background, called as MSME. MSME stands for what? Micro, small, medium enterprise. These are the enterprise whose turnover is in few lakh of rupees. They are the middle class families working very, very hard to meet their ends in life. Such people have supplied the goods to you on credit, and big companies defaulted the payment to these MSMEs. So all these MSMEs started crying. Their business got devastated during that period, because if you don't get the money back on time, how will you again run your business? Business is what? Whatever money you got, initial capital, you invest in the business, you produce the product, you sell it. From the debtor, the money comes back. Again, you buy the raw material, again processing, again selling, again getting the money. So you have put your money, you've sold the product. For 1 year, the money is not coming back to you. How will you do your business? How will you pay your monthly rentals? How will you pay your monthly salaries? So all the micro enterprises, small enterprises, medium enterprises got significantly affected during this period. A lot of big companies defaulted the payment of MSMEs. So now company law said that Just telling how much money to be paid to creditor is not sufficient any longer. You have to tell me this money is due for payment for how many period. So they gave you multiple options. You have to disclose that the money due to MSME is to be paid for less than 1 year. Means what? It is due for payment, but it's been 1 year since I have not paid it. Less than 1 year. If I'm supposed to make the payment to MSME, but I've not paid the money for 1 to 2 years, then I've classified here. I have to make the payment to MSME, but I've not paid the payment for 2 to 3 years. Then here you have to show that value. So basically, this process is called as aging. You're trying to show the aging of the trade payable. Trade payable aging. Aging means what you're showing that this money is due for payment for how long, for how much months or how many years this money is yet to be paid. Aging will always be shown only for creditors and not bills payable. Because bills payable is what? There's a due date agreed. On the maturity date, if you don't pay the bills payable, automatically the bill will get cancelled. So there is no need of showing aging and all. Aging is required for only creditors. So aging is required only for creditors. So MSME means what? Micro, small, medium enterprise. Other means what? Big enterprise who are above MSME. You have to show that, for example, there's one MSME from whom we have taken the goods on credit. It's due for payment, but I have not paid the money for 1 year. Sorry, I have not paid money for 9 months. How much money is yet to be paid? 1 crore. So I show 1 crore here. This one MSME from whom I have taken the goods on credit. I'm yet to make the payment, but I have not made the payment. I don't make the payment for how many months? 18 months. So 18 months means 1 to 2 years. How much? 2 crores. Total how much is pending? 3 crore. Before 2021, what you used to do? You only used to show the particulars column, creditor, and total column amount alone. This 3 crore is pending for how long? We didn't know it. If I'm a government, if I'm a banker, if I'm a creditor myself, new creditor, I did not know this creditor 3 crore is pending recently or this is pending for a long time. Now, when you give this information in the financial statement, who am I? I'm a new creditor who's about to give the goods on credit to you. Now, when I look at your financial statement, I am getting shocked. Oh my God, this one creditor who's due for payment beyond 9 months, that is less than 1 year. There's one creditor to whom this enterprise is not paid for 2 years. There's one creditor whom the company has not paid for 3 years, and the amount is 5 crores. Means out of 8 crores, 5 crore is due for payment beyond 3 years. I will get a thought, oh my God, if this company is not making the payment to these people, what will be my plight? If I supply the goods on credit, what if they also don't make the payment to me? So I will get one awareness. So this information is useful for me. That's what I told you, we are preparing the financial statement, not for companies, not for reporting purpose. It is for those 7 people so that they can make appropriate decision making. So schedule 3 kept all these people in mind, and this is how the format has been drafted. They kept the interest of those 7 peoples, that the transparency should be there. We have to report the data properly so that those 7 people can make a proper decision whether they should deal with the company or not. Am I clear? Now, sometime what happens, certain amount that you're supposed to pay to MSME could be disputed. Means what? I have to make the payment, but I've not made the payment because the case is pending in the court. So if there is any disputed amount, you have to show in the disputed column. If there is any amount that you have to pay, but there is no dispute, you did not pay because you did not have money, there is no case also, then go into point number A. But if you're disputed, means you are asking one amount, opposite person is saying some other amount, there's a fight going on between the both way people, and the amount is withheld, then that will be come under which section? Disputed dues of MSMEs. So MSME means what? Micro, small, medium. Any enterprise which is bigger than the medium enterprise, bigger enterprise, will come under which category? Other category. If it is not disputed, B category. If it is disputed, D category. Now, in examination purposes, this is how you're supposed to prepare the disclosure. Now, if you see in some questions for trade payable, what they have done, they have not given this disclosure requirement. In some question, they have done it. In my opinion, wherever possible, if the data is available, if these data are available, whenever these data are given in the question, which means what? The question wants you to prepare the trade payable in this aging format. This is called as aging format. Means I'm trying to show the age of trade payable. The age of this trade payable is less than 1 year. The age of this trade payable is 1 to 2 years. Means what? This is due for payment beyond 2 years. This is due for payment for 2 to 3 years. This is called as aging of the trade payable. So if the information related to aging is given, you show the aging. If the information related to aging is not given, then directly you can record the amount in the outer column and come. Am I loud and clear? Yes, Viksha.
So bills payable is also same.
Bills payable, the problem is that that problem of creditor will not come here, because what is bills payable? You're agreeing a particular date on which you're supposed to make the payment. On that day, you're making the payment. If the bills payable is not met on the maturity, the bills payable loses its validity. It converts into creditor. So if there is any bills payable which is not paid on the mature date, what is the cancellation of the bills payable entry? Bills payable to creditor. So once it becomes creditor, it comes under this category automatically. Is the logic clear? Online people, is the logic clear? See, some bills payable are
Yes,
there
sir.
for 1 year. Means I put a bills payable today, 1 year later I'll pay. So you cannot put this under aging category. We are talking about those payment which is due for payment, due is come, but you have not paid the money. That aging is what we have to report here. Am I loud and clear? Online people, am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Ah,
Yes, sir.
In the format, sir,
yes.
you wrote current financial year, previous financial year, sir. How we like, sir? You wrote.
See, now when you show the aging, you only show for the current year. Previous year will not show the aging. Previous year, you will take the previous year total and directly put it here. There should be actually one more column coming in between, which is actually current financial year. I'll change that and give. So basically, this is less than 1 year. That is 0 months to 11.9 months. Basically, this is 1 to 2, 2 to 3, more than 3. One column will come. Then final will be the total column. Final will be the total column. Yes. For the previous year, no need to give the aging. Previous year, there will be total column. No, take the total and copy paste here directly. This is trade payable. Now comes other current liability. Now this is very, very important. If this is done, I think we're almost done. Yeah, liability part is over. So this is a little bit tricky. You have to pay your full concentration. With this, we'll wind up today's discussion. Other current liabilities means what? Anything that does not fit, anything which does not fit in the above category. Any liability which does not fit in the short-term borrowing, trade payable, and short-term provision will come under other current liability. In that, they've given multiple bifurcation. We have to understand the meaning of each and every bifurcation. In that, the first item is what? Interest accrued, but not due for payment on borrowing. Can somebody give me the meaning of this? Then there's something called as interest accrued due for payment on borrowing.
Sir, 1 year we have to pay, sir. But the year are different financial years, sir. 22, 23 and 23, 24, sir. So for that year, suppose 8 months after I have borrowed, sir. So next year after 1 year we have to pay, sir. So on the 4 months alone, it is accrued, sir, but it is not due because next year only
due date is coming from it. Got it. I understood his point, but you will listen from me. Within emotion and discourse. Can I take an example for this? Everything example is ready. Now, example 8. ABC Limited took a loan for rupees 1 lakh when on 1st October 2024 at an interest rate of 12% per annum. Any problem in this? Online people, any problem in this?
No, sir.
No,
We're
sir.
talking which company? What is the company's name? ABC Limited.
ABC limit.
What have they taken? Loan. How much value? 1 lakh. What interest percentage? 12%. When did they take the loan? 1st October 24. Data is there in your mind? Which is due to be paid annually every year, starting from 30 September 25. So this is my first date of payment. From 30 September 25, I'll start paying the interest. Am I clear? I'm not talking about principal. I'm talking about interest. Interest is to be paid starting from 30 September 25. That is once that 1 year is getting over, at the end of the 1 year, you'll pay the interest. Okay, that is the due date of the payment of the interest. So can I say 30 September 25 is a due date for the payment of interest? Okay. Calculate the interest on loan. Calculate the interest on loan and classify the same in the financial statement. Okay. Now here what I'll do, I'll draw a time period. Focus on this point very clearly. This is year 1. This is year 2. In which financial year did we take loan? In which financial year did we take loan? Open your mouth and respond, all of you.
25, 26.
Very good. 24-25 loan, which date I've taken? Here can I say 1/10/24 date of loan. How much loan have we taken for? 1 lakh rupees. Interest rate 12% per annum. The question says that this interest will pay after 1 year. So 1 year will end when 30 September 25, the year ends. This is the due date for payment of interest. Do you agree with me, all of you? Now, this is which financial year? 25-26. So actually, when is the liability for? When is the liability for me to pay the money? Actually, liability arises when 30 September 25 is actual date when my liability is actually triggering to pay. Correct? But in between, which concepts comes into picture? In between, financial year comes into picture, and here, which concept will pop up? Matching principle. What is matching principle saying? Matching principle says that, donkey fellow, just because you're paying the interest on 30 September 25, it doesn't mean that you'll record the interest expense on 30 September 24. You have enjoyed the money 1 lakh here for how many months? 6 months. You got benefit for 6 months, no? So following accrual concept, you're supposed to record the interest for 6 months. Matching principle says what? Record the expenditure to the extent the benefit is received. In the current year, you've enjoyed the loan for how many months? 6 months. So for enjoying that money, there's a cost that I have to incur that is called as interest. Am I supposed to make the payment as of now? No. But as per matching principle, since it is enjoyed, the cost for that it is incurred, I have to record that as expense or not. So you will record one entry. So on 31st March 25, I have to pass an entry or not? I have to pass. What adjustment is this? This is outstanding expenses adjustment. Which adjustment? We studied this in 11th standard. One more time in CA foundation called as outstanding expenses. What is the meaning of outstanding expenses? Expense incurred, but money not paid. Am I clear? So what is the journal entry first? Interest expenditure account debit to outstanding interest. How much? 1 lakh into 12% into 6 by 12. How much? 6,000, 6,000. So this 6,000, where will you take in the financial statement? P&L, I know, ma. Where under P&L? As if she doesn't thinks I don't know what to do is good P&L or not. Huh? Goes where under P&L? Finance cost. Wonderful. This is your expenditure, nominal account. It goes to finance cost. Understandable. What is this outstanding interest nature? Liability. Because I have to pay this money in future. So where will I take the 6,000 rupees? Will I take the 6,000 rupees under short-term borrowing? Is the interest component a borrowing for me? No. Principal is borrowing. Interest is not borrowing. So definitely I'll not put this under short-term borrowing. Will I put this in trade payable? Trade payable means what? Any payable that we are doing for the purpose of trading business creditor, bills payable. Any money that I owe to the creditor, that comes under trade payable. Is the person to whom I'm supposed to make the payment is my creditor? Is he helping me in the trade on the regular basis? No, he's not a trade payable item. Will I put in a short-term provision? No. So where does it go? Other current liabilities. Under other current liabilities, we have multiple bifurcation. People get confused in the first two. Will you put in the first one or the second one? Think and respond. Just because I am doing the first one question, it doesn't mean it is for A1. I can do the B question also first. First one. Why? Because it is interest accrued. Accrued for expense. Interest accrued means what? Expense incurred, but not due for payment. When is it due for payment? 30 September is due for payment. So interest is accrued, expense is incurred, but is not due for payment. So when somebody reads this, what do they understand? Why have I not paid this money 6,000 rupees? Because I record this as liability because of the accrual concept. I have not paid because the due date is not come. So anybody who's reading this financial statement will not take me wrongly. Generally, if I have liability, what will the user think? Oh, 6,000 liabilities there. Oh, which means this person has not paid the money. Why this person has not paid the money? Oh, he doesn't have the money. Like that they'll think. So genuinely touch your heart and tell me, we did not pay the 6,000 because we did not have money. Did we default the payment? No, boss. The money itself was not due for payment. The interest was not due for payment. So when I classify this as a separate item, people will not take me wrongly. Am I clear? So this classification is very important for a person to understand. So interest accrued means what? Interest accrued means expense incurred. Why? I enjoyed that money for 6 months. So I have to suffer the cost for 6 months. So interest accrued means expenses. but is not due for payment. So interest accrued but not due for payment. Am I loud and clear? Now what is point number B? Interest is accrued, expense is incurred. It was due for payment, but still did not pay the money. So here now you have to have a bad image about the company. Oh, 6,000 is interest enjoyed, expenses incurred. You're supposed to pay but did not pay. Why did you not pay the money? So now you have to create a negative perception about the company. Maybe the company is not having money, or maybe the company is having dispute with that person. We don't know. You have to be very cautious at this stage. So I'm taking one example for this. So before that, interest is accrued as expense up to 31st March 25. Which concept are we following here? Matching principal and accrual concept. But it is not due for payment as on 31st March 25. And hence it would be called as interest accrued but not due on borrowing. But not due. Due for what? Due for payment. Interest accrued means expenditure to be recorded. Due is in point of view of the payment. It is not due for payment on the borrowing. The word payment here I have fixed it. If you take in schedule 3, the word payment is not there. What have they given? Interest accrued but not due on borrowing. Payment I have introduced because I wanted to make you understand due for what? Payment. The word due and payment I linked it so that you can understand it. If you take proper schedule 3 format, payment word is not there in the schedule 3 format. Interest accrued but not your borrowing is classified under other current liabilities, which is a part of your current liabilities. Is the point clear? Online people, is the point clear?
Yes, sir.
Now comes
Sir.
XYZ Limited took a loan of 1 lakh when on 1st April 2024, 1st April 24, interest rate 12% per annum, which is due to be paid. Interest on that is due to be paid annually every year starting from 31st March 25. However, the company did not make the payment of interest on the set due date. Calculate the interest on loan and classify the same in the financial statement. Now, which financial year did you take the loan? 24-25. In 24-25, when did you take the loan? 1/4/24 you took the loan. Interest is to be paid annually. So annually, when does it get over? 31st March 25, the annual period gets over. So this is the due date for the payment of interest. Do you agree with me? On the due date, did you make the payment? No. So now what is the money enjoyed for how much period? You enjoyed this money 1 lakh rupees for 12 months. So matching principle said that since you enjoyed this money for 12 months, the corresponding expenditure for 12 months Purvi are supposed to record and pay. So now entry will be what? Interest expenditure account debit to outstanding interest. How much? 12,000, 12,000. Donkey fellow. How 6,000 will come? This is what a person is physically present, mentally absent. 1 lakh is the loan Purvi. Interest percentage 12 by 100 into 12 months by 12 months. How much is it? 12,000. Shall I send you back to LKG? LKG. Now, this is your finance cost. This is your finance cost, correct? This is your liability. This will be which liability? Current liability. Because I'm supposed to make this payment actually now 31st March 25, but I have not paid it. Means I have to pay anytime in next 12 months. In 12 months of balance sheet date, anytime I may have to pay this. So this is my current liability. But where under current liability? Other current liability. Where under other current liability? Where under other current liability? Interest accrued, due for payment on borrowing. Interest accrued and due for borrowing, but will not come here. Interest accrued and due for borrowing. Due for what? Due for payment. So interest is accrued, expenses incurred, is due for payment, but you have not paid the payment. You have defaulted the payment. So here 12,000 rupees, I'll classify it here. So A category, company is not bad. But in B category, if the company classifies, something is wrong with the company. Why are you not paying the money when it is due? So it is a concern for us. So those 7 people needs to be properly deal with the company in this case. Any problem here? Online people, any problem here?
No, sir.
Now, all of you are in CA. Result varla no. All of you are where na CA enter. The foundation result 2 days kalta varbo. Now, 24-25. In this financial year, you took services from me for which course? 24-25 You took services from me. For which course? CA Foundation. You paid me 40,000 rupees, let's suppose. CA Foundation 40,000 you paid me. Example. Don't feel bad about it. It's okay. 40,000 you paid. Example, ma. CA Foundation. Example. You know, okay, I'll reduce it. No problem. No, sir. வரம்மா ஏன் கவலைப்படுறேன் 20,000 rupees. Okay, now. Okay. When will I record this 20,000 as income? The day when I completed my service. I told you in CA Foundation, you record your income when the service is completed. If you're dealing with the goods, you record the goods when you record the income against the goods when the ownership is transferred. I'm into service business. So when will I record my income? When the service is completed. My services towards CA Foundation coaching is completed, not completed. Completed. So this is my revenue from operation. Now, in the very same financial year, I am charging. Now, let's say 2 days later, result is coming. All of you have passed. Now, let's say on 5th of March, 6th of March, 10th of March, I am collecting CA intermediate fees. Have trust you will pass. Why are you getting scared? I am collecting, let's say on 10th of March from you, 30,000 rupees for CA inter coaching. What is the journal entry for this? Bank account debit to CA inter coaching fee income. Now this 30,000 is coming to my bank account. So this goes to my cash and cash equivalent, current asset. So this 30,000, where will it go? Just because I've credited, can I take this as income? Credit all income and gain. Is this my income? No. Why is this not my income? Because service is not completed. The money that I'm taking in year 24-25, when will I complete the service? In the month of October, let's say 30 October 25, I'll complete my service. So technically, this is the date when my revenue should be recognized. Correct, no? So this 30,000 what I've taken from you, I've not provided the service. So I may have to refund this money back until I start my class or until I complete my service. So here I will classify this as my liability. This is called as advance income. This is called as money received advance income. Income received in advance. 30,000 is my income. But it's not current income. It is advance income. Always your advance income are your liability. And what liability it is? Current liability. Because if I don't do the services in next few months, I have the obligation to repay this money back. Do you agree with me? So until my income is earned, until my services are completed, this money is not my money. It is your money with me. If I don't do the services, I might have to refund the money back. So until that point of time, this becomes my current liability. Any problem? Online people, any problem?
No, sir.
Income received advance. So any company, if they receive the money in advance, it will be called as other current liability. Income received in advance, it will be a part of your other current liabilities. Any problem? One more time, loudly I'll ask. You have to loudly tell me the answer. Any problem? No, sir. Much better. What is the meaning of unpaid dividend? Yes. I will discuss this point in detail in future, but though I've discussed this concept already in 12th standard, keeping that in mind, I'm just discussing shortly now. This is the financial year that the company is operating. Which year? 24-25. We are in the current financial year. Correct? 31st March 25, our accounting will get over. Basic accounting will get over. But we will take additional few days here to finalize the accounts. Correct? Depending on how big your company is, depending on how big your accounting team is, you will take additional couple of months in the financial year 25-26 to finalize your books of accounts. In that 1 month, what are you going to do? So we are going to pass all the adjustment entries. We're going to pass adjustment entry for closing stock. We're going to pass adjustment entries for outstanding expenses, prepaid expenses, accrued income, unearned income. We're going to do the adjustment entries for all the types of interest on borrowing, debentures, every type of interest calculation is done in this finalization period. During this period, we'll calculate the interest on capital, interest on drawing, if any. During this period, I'll calculate the depreciation, amortization. So all this requires time, no? So I'll take 1 month of time to finalize my accounts. Okay. After that, what happens? The auditor of the company will come and do the auditing. Before the auditor signs the balance sheet, what happens? There is one meeting called as Board of Directors meeting. In the Board of Directors meeting, what they do is they propose dividend. They propose the dividend. Once the dividend is proposed, the information of that has been captured by the auditor in the financial statement, and then the auditor signs the report. So where does this proposed dividend is being disclosed in the financial statement? Under contingent liability. Those who know this concept, it's okay. Those who don't know this concept, do not panic. When the right time comes, I'll discuss this point one more time here. So this proposed dividend is a contingent liability. Why it is contingent liability? Because the payment of this dividend is dependent on a future event. What is a future event? AGM. So after the financial statement is signed by the auditor, can you see this is signed? Look at my creativity. This is called a sign. Shock reaction. As if I've done something. Now, this is signed. Some auditors saying, what is wrong in that? Once the financial statement is signed, the company will prepare the annual report. And they'll send this annual report to whom? To all the shareholders. Shareholders will go through all the different reports of the annual report, and they will be invited for a meeting called as annual general meeting. In the annual general meeting, they'll be discussing multiple points. In that, the couple of points are appointment of directors, appointment of auditors. So we will now take the approval from whom? Shareholders, because they are also owner, no? Every decision making, if the company is taking, then power chiller fellow, what shareholder will think? You are telling me owner, no power you are giving to me. Power, no power. So for namesake, what they do? For namesake, what they do? You come to AGM. I'll give you 4 options, 4 decision making points. You do voting. You enjoy. You are also owner, no? You also enjoy voting. So we have to vote for the auditor. So like that, there are few matters you will discuss in the AGM. Who will teach you this in depth? Law teacher. Preeti ma'am will teach you what will happen in AGM, what drama dance will happen in AGM, that Preeti ma'am will handle. Now in the AGM, apart from other points, there's one point where the shareholders have to approve the dividend. The moment they approve the dividend, this proposed dividend becomes the final dividend. Once in the AGM, the dividend is approved. Once in the AGM, the dividend is approved. What happens? You are now liable to make the payment to the shareholders. Within how many days? 30 days of the approval. Within 30 days of approval, you are supposed to make the payment to the shareholders. So on the date of AGM or the next day of the AGM, the accountant has to pass one journal entry. What entry will the accountant pass? Donkey fellow, statement of P&L account debit. When I give the dividend, my profit will increase or decrease? When I pay my dividend out of profits, my profits will decrease after paying the dividend. To increase profit, credit. To decrease profit, debit. So statement of P&L account debit to dividend payable. Let's say it is 1 lakh, 1 lakh. So now this dividend payable will be classified as where? Under other current liabilities. So within 30 days, I gave the check to all the shareholders. What are the shareholders supposed to do? They're supposed to go and encash the check. They have not encashed the check. Is it my fault? No. So if any check which I have sent, which the people have not encashed it, it is called as unpaid dividend. It is called as unpaid dividends. Whenever they encash it, I'll give it. So hence it is a part of your other current liabilities because I'm yet to make the payment. If they put the check for clearance only, then my banker will make the payment. Otherwise, why will my banker make the payment? So hence this is my unpaid dividend. Means what? Dividend approved by the shareholders in the AGM. We have given the check to the shareholders. Shareholders did not claim that amount. So it is unpaid. Means we have not paid. It's not like we have not paid it. They have not received it. Now one more thing is there. There's one more, different school of thought. There's something called as unclaimed dividend. Now, unpaid dividend could be what? In that 30-day period, see, I have 30 days to issue the check. So if the check is not issued for this 30 days or in between period is there, no? In this period, you can call that check which is not yet been distributed, could be called as unpaid. Means what? I have not yet issued the check. So if I'm preparing the balance sheet, let's suppose somewhere here, that is in between the 30 days, so that could be my unpaid dividend. If any check that you've given to the customer, if the customer does not claim it, it goes to the unclaimed dividend. It goes to unclaimed dividend. Now, there's a concept here which I'll be discussing that if the dividend, which is given to shareholder, the shareholder is not claiming it, it is stayed in the unclaimed dividend account for how many years? Let's say 7 years. From that, it is going to investor protection fund. This concept is there. I'll discuss when the right time comes. And this will be discussed one more time in depth by your law teacher. So there's something called as unpaid dividend. There's something called as unclaimed dividend also. Now, both when the right time comes, I will discuss. As of now, no. In both the cases, these are the money yet to be paid. Okay, I will not discuss what is unclaimed dividend properly. Because if I discuss the time will be too much extended. The purpose for discussion for this chapter will not be, curtailed, it will be unnecessarily expanded. So here I'm cut shorting the discussion here. There's something called as unpaid dividend, there's something called as unclaimed dividend. It will be discussed in depth by your law teacher once. And one more time when the appropriate time comes, I'll be discussing what is the difference between the both. Why we have to keep that money with us for 7 years, and why we have to give it to government after 7 years. There's a law procedure for that, so that will be discussed later. So if any unpaid or unclaimed dividend is shown in the question, where will you classify them? In other current liabilities. Am I loud and clear?
Liabilities of the previous year.
Yes, this is dividend of the previous year. Now, excess application money refundable and interest accrued thereon. Excess application money refundable. Excess application money was over subscription. You have offered 50,000 shares to public. People have subscribed for 60,000 shares. And this is the case of full amount, lump sum amount. So now 50,000 10 rupees, you are allotting 5 lakh rupees to equity share capital. But how much money have you received? 6 lakh rupees you have received. In that 6 lakh, how much will you transfer to capital account? 5 lakh. Baki 1 lakh you have to refund, no? So until you refund, this money will be a liability. So where under liability? Under other current liability. So excess application money which is refundable, and on that if you're paying any interest, then that interest put together will be shown under other current liability. Yes, if at all it is there, article of association permits it, then yes, you have to add interest also. If it is not paid, then interest will come, no? See, within 15 days, you're supposed to repay the money. If you don't repay the money, the company is taking 30 days to repay. What will you do? Interest has to be charged. That is where the word interest is coming to picture. Am I loud and clear? We have a question based on that also. PwC Limited issued 50,000 equity shares of 10 each. Application received for 60,000 equity shares between 27th to 29th March. However, the allotment was made by the company on 2nd April 24. You are required to present the above information in the financial statement to be prepared as per Schedule 3. So on 27, 28 and 29, when you receive the money in your bank account, what your journal entry is going to be? Hari? Bank account debit to equity share application. How much? 60,000 shares into 10 rupee, 6 lakh. Now here the year end happens because allotment is happening when? On 2nd April, which is the next financial year. Now the question is, this 6 lakh rupees which is credited, how will you show this?
5 lakh will go to some part.
5 lakh will go where? Share application money pending allotment, and 1 lakh will go to your other current liabilities because you're supposed to refund it. So 5 lakh rupees is going to share application money pending allotment because for 50,000 shares which I've offered, I'm going to allot the share for sure. But allotment is happening next year. So until then, it is pending allotment. So share application money received, I'm also keeping the money. I'm not going to refund it. The allotment is confirmed going to happen. So that amount goes to your share application money pending allotment. Remaining 1 lakh, I cannot keep it. Just because people wanting to buy my shares, extra application is come. Company law does not allow to keep that extra money. You have to refund it. So in that case, it becomes my other current liability because I'm supposed to make the payment within 15 days of closure of the application. So now, this is 1 lakh rupees current liability. But where under current liability? How many options are there? First is what? Short-term borrowing. Can I put in short-term borrowing? No. What is second option? Trade payable. Can I put in trade payable? No. Third is other current liabilities. Fourth is short-term provision. Can I put in short-term provision? No. The only option is other current liabilities. Under other current liabilities, where excess application money refundable and interest, if any, thereon, that also should be combiningly shown. Any problem?
No, sir.
E over. F and G we discussed already.
Yes, sir.
Calls in advance. What is calls in advance?
Before the all money is called, they are paid.
Super. Now, for that also I have a question. Other day we discussed, I told you, no, these 4, you remember when I discussed the share application pending allotment, 4 questions we discussed, 4 cases. And I told you that 4 cases I'll document and give it. Documented. We discussed all these cases orally. You gave me gloomy faces. I felt very bad. Oh, okay, my students did not understand. Put examples. XYZ Limited issued 20,000 equity shares payable on application 3. Allotment 3. First and final call 4. Total how much? 10. Application were received for 40,000 equity shares between 27th to 29th March 24. How many shares have you offered? 20,000. How much have you received? 40,000. Whatever subscription this is, over subscription. However, the allotment was made. However, the allotment was made by the company on 2nd April 24, and the company decided to retain the excess application money to be adjusted towards cost. Correct? You are required to present the above information in the financial statement to be prepared as per Schedule 3. So tell me, people. This question goes to those people who have not studied foundation properly. My question goes to those people who are coming into data entry without the basics. You've done basics, so no problem. But imagine if this is not done. At this point of time, do you think I'll be in position to explain this entire question? Here, we have to discuss the disclosure. Imagine the person who studied 11, 12, let's say matriculation or state board, 3 years college, enjoyed Majani life, directly coming and sitting in CA intermediate. That is from level 1 to level 8, direct jumping. What will be the plight of that person? Can you even understand what we're discussing now? Not possible. Can I sit and discuss, or me or any faculty for that matter, can we sit and discuss what is XYZ Limited doing? What is 20,000? What is 40,000? What is the meaning of oversubscription? What is undersubscription? Can I discuss all the entry by entry, one by one? Not possible. So any of your friend who's planning to do data entry, who's got a BCom degree, no doubt let them do it. But what are they supposed to take care of? Basics. CA foundation accounts has to be taken care of. All of you agree with this point? All of you agree with this point? Touch your hand and tell me. Just because I'm asking you, don't see. You genuinely agree with this point? Boys, both of you agree? Genuinely, I'm asking. Correct? So, as a teacher, single person, how much advice will I give? Tell. If any of your juniors come and ask, if you know this point, can I say you can also guide them? One person, single person, how much I can guide? So if I'm the tree, all of you are branches. If the branches also take care of all the guidance, imagine if I can guide 1,000 people, and those 1,000 people can guide again, let's say even 100 different people also. How many people we can mentor and guide? So many people who go out of track. Imagine how many people we can bring them back on track. Only purely lack of awareness. A lot of people ask me, sir, if you tell that basics are so necessary, then why is the institute allowing the data entry option? Correct? No? What institute doesn't know that we don't know basics? So they could have very well told, do basics and come. Why are they entertaining the data entry students? Please understand there are certain BCom courses where the concept is equivalent to CA foundation. There's something called as BCom honors. There in BCom honors, you have the syllabus at par with the CA foundation. And like other BCom, you cannot just casually pass. You have to properly understand and pass the exam. There's something called as plain BCom. There's something called as BCom honors. So BCom honors is slightly challenging. So back 15 years ago, people said, sir, we have done BCom honors. Whatever is there in CPT and foundation, we have studied properly. So why to unnecessarily study one more time? So institute said, logically, it's correct. So they allowed people to do that entry. Can CA institute sit and check whether you're BCom person or BCom honors? Can they check? Not possible. Now in BCom, we have 15 variety like dosa variety. BCom PA, BCom A&F, BCom F&A, BCom CS, BCom CA, BCom CMA. The dosha shop owner also is now wondering, where is my variety? Where is BCom variety? That much variety BCom people have introduced. So can institute sit and check which BCom person is studied accounting properly or not? Is that the job of CA Institute? No. So CA Institute said that if you are coming from a data entry, if you feel your basics are strong, you come to inter directly. Otherwise, you come from the foundation. Can CA Institute sit and check everybody one by one? All over India can sit and monitor? Not possible. But what people mistook, oh, I have done college over, degree over, I'll come directly to intermediate level. Arey Baba, in intermediate level, it is advanced accounting. Accounting A also you don't know. Advanced accounting, what will you do? No, that's not the fault of the student also. It's not college also. Lack of guidance. Lack of guidance. See, what he's knowing, the student knows that there's a data entry option. Whether that option is right or wrong for me, who has to guide us? Either CA Institute or the coaching centers like us. Who does it? Nobody does it. Even if somebody is trying to tell also, the student and the parent are not willing to accept also. Very few people accept it. Like these boys, they had acceptance. Ama sir, they accepted it. Now they're doing basics. It is very rare that these boys or these type of people accept it. Others, majority of people, they don't understand. Who will sit and waste time for 6 months of basics? Sitting and studying for 6 months is not okay, Amma. But sitting in the class, not understanding, suffering for 1 year, giving the exam, failing is okay. But studying 6 months extra is not okay. What kind of mentality is that? You're coming and sitting in this chair of a CA, anyhow the question can come, be targeted. They can ask you questions. If you're not in position to answer, then even if you become a CA, what CA are becoming, boss? See, after becoming CA, people take specialization. Let's suppose I've taken specialization in accounting. So now if you come and ask me anything about DT and IDT, I may not be able to answer because I'm not an expert in it. But at least when you're a student, you're studying everything now. For the first 1 year, you're raw. You know everything. You're fresh. You've studied everything is here. So if I ask you, what is DT, IDT, FM, you should be able to tell answer instantly. That is the level you have to prepare yourself. This is one of the primary reason why intermediate has got highest number of failures. Purely because of that interview. So my humble request is, if you have any student or friend, seniors who are opting for that entry, guide them to do the basics. Not necessary to do here. They can go and do from anywhere. But do basics, get understanding, because a lot of terms is connected to the CA foundation level. If they're not used to those terms, they cannot survive in the intermediate level. That too, I'm leaving advanced accounting and a little bit law. Income tax, GST, you study a freshman. G for GST, you start now only. I for income tax, you start now only. No problem. But advanced accounting is advanced level. You cannot expect the teachers to go for basic teaching. So my whole point of discussion here is that if you come across any person who is trying to do wrong decision making, please guide. One single person, I cannot make the impact. When I can do so much of guidance absolutely free of cost to so many people, that is a moral social responsibility. As a CA person in the CA fraternity, I feel it is my responsibility to guide people. And I feel every student of mine should take the responsibility, and you also should get in the role of a mentor and guide. And wherever possible, please guide. One person cannot make the difference, but all of us put together can make a huge difference. So please have this point in your mind and kindly help the people wherever they require. Now the big question is, what is the journal entry for this transaction? Let's come back. Bank to equity share application. What is the amount?
1,20,000.
Oh my God, he is selling 1,20,000. Others. Kriti is like, donkey fellow. Self-confidence. 40,000 equity shares into 3 rupees per share. How much? 1,20,000. Bank account debit to equity share application 120, 120. Can I record this entire 120 under your capital? Sir, allotment is not done. How can I take it to capital? I will take to share capital only when the allotment is done. So this cannot go to share capital. So where will this 120 go to? Sir, I have to break down this into multiple parts. Out of this, 20,000 shares into 3 rupees, which is how much? 60,000 rupees I'm going to allot on 2nd April. So this 60,000 will go to your share application money pending allotment. Correct? Remaining 60,000 rupees, I am not going to refund. I am going to adjust with the subsequent call. Means what? I have to make or I have to collect money from the allotment stage and the first call stage. No, I will adjust against it. So I will take the remaining 60,000 to calls in advance. So what is the entry that you normally pass in 12th standard or CA foundation? Equity share application to equity share capital to calls in advance. So 1,20,000, 60,000, and this is 60,000. So until you allot, this will go to your share application money pending allotment, and this 60,000 is calls in advance. Will go to your other current liability. Why it is other current liability? Until I allot the shares, I am not eligible to receive this money. But I've received this money, so we treat this as advance. I might have to pay back. I might or may have to pay back if asked for. If the person says, give my money back, I by mistakenly paid it, you have to pay it. But generally, you don't repay it. You will understand this in law when you discuss in detail. But accounting wise, we don't go into that much deep. For us, this is what advance money. Advance money is always other current liability. So where in the other current liability you will disclose? Under calls in advance, not arrear, madam. Calls in okay, then okay. I heard it as arrears. Okay, no problem. It is calls in advance. Any problem? So 60,000, the first is 60,000 rupees. That is 20,000 shares to be allotted into 3 rupees will be classified as share application money pending allotment, as the shares are going to be allotted subsequently for sure. However, the remaining 60,000 rupees is termed as excess application money to be adjusted with the subsequent calls, and hence it will be classified as other current liability under current liability. Under other current liability, which part? calls in advance. Make sense?
Yes, sir.
If there is any other current liability, you will classify under other payables, such as what? Excess application money to be adjusted. No, not this. Amount to be refunded when the minimum subscription is not received. Amount to be amount to be refunded when the minimum subscription is not received. For this also I have a question. I don't.
Minimum subscription.
Yes. I have question. I'm coming. Here. Example 4. ABC Limited issued 50,000 equity shares of 10 each. Application received for 30,000 equity share between 29 to 31st March. This is lump sum or installment? Lump sum. In case of lump sum, what is the minimum subscription? 90% by SEBI. 90% or the percentage what the company says, whichever is higher. So here nothing is set by the company. So minimum subscription 90% will take it. So now 50,000 share into application money is how much? Full 10 is application money. How much? 5 lakh. Into 90% is how much? 4,50,000 money I should have received it. But how much I received? I received only on 30,000 equity share. How much? 30,000 into 10. I received only 3 lakh rupees, which means minimum subscription criteria not met, which means I have to refund the money. So now the entry is what? Bank account debit to equity share application. 3 lakh, 3 lakh. So this where will I classify? After 31st March, that is on 1 April onwards, I am supposed to refund this money. So any money that is to be refunded within 12 months of balance sheet date, it is current liability. But where under current liability? Other current liability. Under other current liability, which part? Other payables. Other payables. Any problem? All the different kinds of question addressed. Liability part over. So now, with God's grace, we'll pray God that I said we should finish in one class. Tomorrow, 10 o'clock to 1 o'clock. Why I'm praying God? Because God should give you nice buddhi. So when I discuss some points, you don't give me gloomy faces where I sit and discuss extra points and waste extra time. Correct, no? So next 3 hours, that is tomorrow from 10 o'clock to 1:30, we should be done with assets. So that Monday evening, I can start with questions from ICA module. The proper questions will come for the purpose of your intermediate examination. Okay. Now we're not done. Hello, where are you going? Wait. Balance sheet, full formatted discuss. Balance sheet has got how many broad classification? 4 broad 2 are. Equity and liability kulla enna irukku? Oh, I said balance. Oh, sorry. I said balance sheet has got how many classifications? You said 2, right? Okay. One is equity liability, second is assets. Oh, my mistake. Sorry. Under equity and liabilities, how many sub-classification? 4. First one is shareholders funds. Then share application money pending allotment. Then non-current liability. Then okay. Under shareholders funds, how many sub-classification? 3 sub-classification. First one, share capital. Second, reserves and surplus. Third, money received against share warrant. Okay. Under non-current liability, how many classification? First one, long-term borrowing. Third, sir. Second, sir. Deferred tax liability, net. Other long-term liabilities. Other long-term liabilities will come or other non-current liabilities will come. Other long-term liabilities, non-current will not come. Then long-term provision. Can we change this order? Face of the balance sheet you cannot change. Inside that, when you give notes to accounts, can you change the order? Try wherever possible. You do not change. Like wherever possible, don't change it. If not possible to follow that order, you can change it. You have the privilege. Under current liability, how many classification? 4. Are you sure?
Yes, sir.
So non-current also 4, current also 4. Okay. Short-term borrowing. So long-term borrowing is 1 means short-term borrowing also here is 1. Then instead of detail it is trade payable. Then other current liability. Yeah, invent பண்றீங்க புதுசா Other current liabilities. Then short-term provision. Instead of long-term provision, short-term provision. Here other long-term liabilities, here other current liabilities. Any difficulty to remember? Now some people have this drama. What they'll do? LDOL. By heart. LDOL, LDOL. Will you sit in by heart all this? You can do it if you want it. Dot point something you can do. What is this? STOS. 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 என்ன வேணா போடுமா உன் புக்கு உன் நோட்டு உன் மண்டை என்ன வேணா போடலாம் தயவு செஞ்சு நீ விட்டுருங்க I am against all this. If you're very particular knows that this is how I can remember, I have no problem. Something should be done for remembering, so you are free to do whatever you want to do. I will not interfere in all that. My best way of remembering what this entire balance sheet format I'll read at least 15 to 20 times in next span of 3 months. ஏமா இவ்வளவு ஷார்ட் ரியாக்ஷன் கொடுக்குறேன் next 3 to 4 months this entire balance sheet format read 15 times. You will never forget it. Now sir, now still it is left over. இருங்கடா why this colaveri? I'm leaving now. For that you'll hit with me, hit the bottle with me. He path the bottle inge eduthu veinuma adichu poravanga. Okay, under long term borrowing, what is the first category? Ayyo appadinu category kediyadhu bonds and debentures. Second, just roughly you tell me. Term loan. In that secured unsecured you have to bifurcate. See, deferred long term borrowing நீ கிரியேட் பண்ணுமா நீ சொந்தமா கிரியேட் பண்ண எல்லாத்தையும். Deferred payment liabilities. D. Financial order change பண்ணலாம்னா இப்படியா? Deposit. Deposits. Then loan from related parties. Then long-term maturities of finance lease obligation. Long-term maturities of finance lease obligation. Then other long-term. Other loans advance. You create macha. You create. Sondama create panni. Schedule 3 utarlam. We'll leave schedule 3. Piyush format will start freshly. Now other other long-term liabilities. Other long-term liabilities. Trade. That's what trade payable. That's what I said. No. Other long-term you said. Somebody. No. Trade payable. Long-term creditor payment. Long-term bills payable payment. Then others. Okay. Others I'll accept. No problem. Under long-term provision, we have 2 categories. Long-term provisions pertain to employee benefit and then others. Very good. Short-term borrowing, copy paste like your long-term borrowings, but one thing will come. Current maturities of long-term debt is something new which is not there in long-term borrowing. Trade payable, what is important here? Aging. So what is aging? 0 to 1, less than 1 year. 1 to 2, 2 to 3, more than 3. Okay. What is the bifurcation? MSME undisputed. Others undisputed. Then MSME disputed. Others disputed. Very good. Other current liabilities. Interest accrued and not due on borrowing. Then interest accrued and due for payment on borrowing. This is good or bad? Good. This is good or bad? Bad. This is good. Interest recorded, payment not made because it is not due. So I have not defaulted. So I am still a good boy. Here I am a bad boy because it is due for payment. Liability triggered, but I did not make the payment. So I am a bad boy. Next. And order matra. Third one. Income received in advance. Very good. Unpaid dividend. Very good. Unpaid dividend. Then excess application money to be refunded. Excess application money to be refunded. Then unpaid matured debentures or unpaid matured deposits. Unpaid matured debentures or matured deposits. Then calls in advance, and then other category. And then other category. Okay. Coming to short-term provision. In short-term provision, what is the first item will come? Always. Provision for tax is always short-term. And then you have others. Employee benefit and then other category. Yes. Any problem? Overall comfortable? So this PDF I'll be sharing with all of you tonight. Please revise and come for tomorrow's session. So tomorrow my discussion will be on the balance sheet part. Hopefully we'll be done with the balance sheet asset side part. Hopefully we'll be done with that. And Monday will be good to start with the practical question from your ICA module. So guys, that's all from my side for this session. I'll see you all in the next class, which is tomorrow morning, 10 a.m. sharp. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you.
Thank you, sir.